the AI theme is still expected to do most of the heavy lifting for earnings growth.
We think the market has been a momentum, growth, and size market this year.
We're hoping that some of that performance can spread into the smaller cap area.
We all know breadth has been far too narrow, right? And that leadership needs to expand.
I really want to see which way the earnings go. The big tech names, continue their dominance. Maybe things get a little bit better. I can see investors going back there pretty easily.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Bloomberg Surveillance starts right now, live from New York City this morning. Good morning for our audience worldwide. Equity futures on the S&P 500 just a little bit softer. Coming into Tuesday after snapping a 3-day losing streak on the S&P. The Nasdaq 100 with its best day since early June. The Mag 7 is back, bouncing back in a major way, and the earnings drop a little bit later on this afternoon. It begins after the close. We will hear from Tesla and Alphabet. Then on to next week when the majors start to report in a much bigger way. A little bit later this morning, Bram, I want to watch 6:30 GM.
Yeah, we've got GM this morning. We also have UPS. We also have Coca-Cola. We have about 20% of the S&P 500 market cap reporting this week alone. This is when we start to talk more about what companies are actually doing, which is something that a lot of investors who come on this show say that is actually tradable versus just simply the speculation around macro as well as political noise, as a lot of people are trying to call it.
How many people have come on this program and poured cold water over the small caps in the last 24 hours? We had David George of Baird coming on and saying, fade the rally that you're seeing in regional banks over the last few weeks. Lisa Shannon of Morgan Stanley making a similar point, saying, don't chase this, don't chase this. Barclays, this note just drops. So bear with me as I read it for you. Mid-year outlook, upgrading the price target, 5,600 from 53. Guess what they like? They like growth stocks. They say the recent sell-off looks contained. Lisa, valuation reset leaves more room for preferred themes. One of those themes, large over small.
This is what we have heard from so many investors. Even when we have later this morning, someone who focuses on small caps, Jill Carey Hall of Bank of America, she thinks that they're undervalued, but sees reason for it in terms of small caps. The issue here is that the winners are going to keep on winning, and the idea of any sell-off or pullback in the Magnificent Seven evidently is being viewed as a buying opportunity. John Stoltzfus, also coming up later, has the same idea at a time when people really recognize that the economy is slowing.
Phrase of the week so far, you used it, cut through the noise. Noise being politics. Let's talk about the politics. Kamala Harris, 81-year-old President Joe Biden stepping aside, stepping out of the race. What did she raise in 24 hours? $81 million. Can't miss that.
You can't miss it. A lot of the donors really and the funds were drying up when there was speculation and concern about whether or not Biden could continue on this path and seek re-election. Within 24 hours, you do see some momentum behind her. She's re-energizing the base. The more interesting stat on that is more than 60% of these donors are first-time contributors to the 2024 race. So this just shows that she's bringing a lot of excitement. Obviously, she's somewhat of a fresh face. She's young when it comes to this Democratic ticket. That's exciting a lot of people. And today, Jonathan, it's really going to be her kicking off the campaign in earnest when she heads off to Milwaukee, Wisconsin.
Just getting some numbers I want to bring to you as well before we get deeper into the politics. Let's talk about UPS. Second quarter results just dropping. EPS coming in at 179, the estimate 198. Revenue, Lisa, coming in at 21.8 billion, the estimate 22.21. So a little bit of a downside surprise on the top and bottom line there.
And talking about full year expected revenue of about 93 billion versus the expected 92 to 90, almost 95 billion. So really even ratcheting back expectations for the full year. When you look inside the numbers, what I find interesting, and this goes to the macroeconomic backdrop, how much is this because consumers are actually spending less on shipping packages? U.S. package revenue was down about 2% year over year and below estimates. International package revenue also below estimates. How much are we looking at a retracement that goes beyond just simply a goods versus services shift to people being a little bit more discretionary?
Isn't this the biggest challenge to the broadening out story of the moment? The earnings picture we're getting from the airlines, not great. Started with Delta, saw it with Pepsi. Are we seeing it again this morning in UPS?
I'm curious to hear what somebody has to say. That is what it smells like, although UPS has been facing a lot of issues with respect to revenues, with respect to expenses, cutting certain businesses in response to labor negotiations. However, that said, we are definitely looking at increasing commentary from companies saying this is a different consumer, one that is ratcheting back and much more price sensitive. And perhaps we're seeing that today in the UPS numbers.
That stock is down in the pre-market by a little more than 4%. We mentioned this moments ago, 6:30 Eastern time. So in about 26 minutes, we'll get numbers from GM. Look out for that. Equity futures right now on the S&P 500, a little bit softer. We're down 0.1% in the bond market. Treasuries rally, yields are lower by a couple of basis points, 423. Can't get through a bond market check without talking about what? Supply. Lisa, what's coming up?
We've got $69 billion of two-year notes today. We've got $70 billion of five-year notes tomorrow, $44 billion of seven-year notes on Thursday. This matters at a time when people are talking about the one constant, no matter who wins the presidential election, that is the fiscal deficit, and that no one is talking about reducing it in any kind of material way. That is the reason why bond supply matters.
That's the promise right now. More debt. More debt. That's something they can deliver if you want it. Coming up this hour, Brian Levitt of Invesco following the S&P 500's best day in more than a month. Isaac Boltansky of BTIG as Kamala Harris closes in on the Democratic nomination, and Bloomberg's Trade Trudell ahead of Tesla earnings after the bell a little bit later. We begin with our top story. The S&P 500 posting its best day in more than a month as investors look through messy politics. Brian Levitt of Invesco writing this: I don't believe that these markets will be trading based on Trump's or Harris's prospects, but rather on the direction of the economy and Fed action. I find the talk of the Trump trade versus the non-Trump trade to be much ado about nothing. Brian, good morning. That's music to the ears of a lot of people after politics has dominated the conversation in this country, in this market as well, for the last few weeks. What do you think is the number one issue right now?
I think it's the direction of the economy. And so you may remember I was here about a week ago and I said, for the first time in a while, I'm getting a little bit more defensive. Then you have a big rally in small caps, and my thought is, oh, these folks are never going to have me back. But I still continue to believe that we want to be a little bit more defensive. It doesn't mean equities can't do well, but to what you were talking about earlier, it's the larger cap, it's the higher qualities, because growth's slowing. Now, ultimately, I think the Federal Reserve pivots. So for the week after I was on the show, the focus was on the Fed cutting rates. Now the focus is back towards growth slowing. We'll get to the point where the focus is again on the Fed. We've priced in the couple of rate cuts now, and things will broaden out. But in the near term, it's more of a defensive environment as the economy slows.
I've got a quote in front of me from Morgan Stanley, and I think it might resonate with you. It's from Lisa Shallett. She said, unlike cyclicals and unlike cycles, when Fed rate cuts precede recession and re-accelerating economic growth sustainably impacts the high beta small cap cohort, this time a Goldilocks soft landing is apt to reward large cap quality names that can deliver margin gains despite modest economic growth. Is that how you're thinking about things?
It is, although I wouldn't say that it doesn't involve the small caps. Because if you can get through this period with without a recession, I agree, then large caps should do well, the broad market should do well. But typically, if you look historically when the yield curve normalizes, the yield curve normalizing, you tend to see more participation from small and value. And investors have been wondering why this market's been so narrow. We've had 20 months of an inverted yield curve, maybe 21 months of an inverted yield curve now. So that's a challenge. This will change as we normalize the curve. But the problem in the short term is that we've priced in the rate cuts and the economy's slowing. You know, we've priced in a couple. So we'll need to see more carry through and more signs that this economy can be resilient before things start to broaden again.
I like that the market message and the political message is the same. It's the economy is stupid. And look at what's going on with respect to consumers and their happiness level. Are we getting a signal from the likes of UPS, from the likes of the airlines, from some of the commentary that we've heard early coming out in this earnings season that highlights just how quickly growth is slowing to you?
Yeah, I think so. And look, we have to remember that was the wish. You know, it was a year ago when things were robust and everybody was worried about inflation. And we heard things like hyperinflation and stagflation, and everyone was trying to be hyperbolic on these things. That was never going to be the case. The reality was the Fed was going to slow the economy. The fiscal stimulus was going to moderate, and consumers were going to start to slow down. Inflation was going to come back into the comfort zone. So that's where we are. So we can't wish for something and then when it happens, be disappointed that it's happening. And so, yeah, things are slowing in the U.S. The global economy slowing in the U.S. is a big part of that right now.
How do you assess whether this is just one data point on a different kind of trajectory downward that's perhaps a little more dramatic versus simply the Goldilocks softening that everybody was hoping for?
Well, if you look for the guideposts on a path to recession, usually see cyclical excess. We don't have that. We do have the inverted yield curve. So far, we're 1 out of 2. You see signs that the economy's slowing. You look at survey data. It's not great, but it's not collapsing. And then the most important one is our credit spreads widening and our bankers tightening lending standards. Not really. So you would look at that and say the economy is in reasonably good shape. It doesn't suggest a recession, but the survey data suggests things are certainly slowing down.
If you don't think right now the Trump versus non-Trump trade is much ado about nothing, when does it become something to do about something?
I'm not sure it does. I know, my big North Star on that, I've been watching it the entire time from the day Trump was elected through the day Biden was elected, the market was up 70%. Since Biden's been elected, the market's up 70-something%. So I'm not sure why people focus on this that much. And I'll give you an example. When it looked after the debate, post-debate, and Trump's numbers are going up, probability of winning, I'm getting these notes in my inbox that say, okay, here's the Trump trade. Crypto goes up. European defense companies go up. You want to be short Chinese equities. And I'm scratching my head saying, wasn't that the last 4 years? Right? That's exactly what happened over the last 4 years. The other thing is, if I were to have been here in November 2016 when Trump won, and I said, what would win, traditional energy or clean energy? Everyone would have said traditional energy, clean energy won by a lot. The exact opposite happened under Biden, where traditional energy won by a lot. And I have people saying to me, drill, baby, drill. If Trump wins, surely we're going to get back to drilling. We're drilling more barrels of oil right now than ever before in U.S. history. So I think people are looking at this wrong. I think people have their own perceptions, their own confirmation biases that they bring to it. But when you dig deeper, right, the Trump trade is energy and financials. Energy and financials did better under Biden than they did under Trump. So it just doesn't add up when you look deeper into it.
Let's park history and let's focus on one specific thing, policy and where we are right now. Mm-hmm. If you come in now and cut immigration and put up tariffs and put up walls around the United States of America, do you not see how that would be inflationary? If you extend the 2017 tax cuts, do you not see that that would be boosting the deficit at a time where actually there are things that people are nervous about, the prospect of inflation re-accelerating, the ability of the Treasury market to handle that additional supply?
Well, it may also be happening at the same time that the consumer is slowing a bit in here. So, you have counteracting forces against inflation, things like AI, things like older population. So I wouldn't necessarily say it's inflationary. To the market, what's going to matter most on all of these things is clarity. Give us some understanding of what this looks like, rather than when we did it in 2018, there was uncertainty. And so business investment dried up for a while with a lack of understanding of what it was going to look like. So long as there's clarity, the business environment will be able to handle it. Consumers will be able to handle it. And look, the reality is both sides seem to want to pursue somewhat of an American first agenda. So there's not a substantial amount of difference with regards to this America first approach.
All those conversations about politics you've been having on Wall Street, freezing cold water. All over it. From Brian Levitt of Invesco. Brian, it's good to see you.
My pleasure.
Thank you, sir. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's get across to Danny Berger. Morning, Danny.
Good morning, John. Secret Service Director Kimberly Cheadle is facing bipartisan calls for her resignation. Cheadle told lawmakers she takes full responsibility for security lapses, which led to the assassination attempt on former President Donald Trump. Cheadle went on to say the Secret Service was made aware of a suspicious person between 2 and 5 times on the day of the rally where Trump was shot, but did not go into further detail. Shares of Porsche slumping in Europe. It cut its outlook for the year, saying a shortage of aluminum parts will affect all of its vehicles and could impact output by several weeks. This shortage will also cause it to stop production on some of its models. Porsche is now expecting a return of sales up to 15%, down from 17%. The company is also reducing its forecast in China and the proportion of EVs it will sell. Warner Brothers Discovery offered to match Amazon's NBA TV rights package, taking advantage of a clause in its expiring contract with the NBA. The NBA is on the verge of signing an 11-year deal, $76 billion, a broadcast package with ESPN and 2 new partners, Comcast, NBC, and Amazon. Amazon agreeing to pay about $1.8 billion annually. Warner Brothers, which has over $40 billion in debt, has obtained a letter of credit to support its bid, according to Bloomberg reporting. And that's your brief, John.
Hey, Danny, thanks for that. Up next on the program, Kamala Harris hitting the campaign trail.
It is my great honor to have Joe's endorsement in this race. And it is my intention to go out and earn this nomination and to win.
That conversation just around the corner. That's up next, live from New York City this morning. Good morning. Live from New York City, welcome to the program. Pulling back just a little bit on equity futures. We're down by 0.05% after a decent rally yesterday across the board. Bond market rallying into some supply through the week. Lisa will bring you the numbers again in just a moment. Yields are lower by 2 basis points. The 10-year, 422.91. Under surveillance this morning, Kamala Harris hitting the campaign trail.
It is my great honor to have Joe's endorsement in this race. And it is my intention to go out and earn this nomination and to win.
The name has changed at the top of the ticket, but the mission hasn't changed at all. And by the way, I'm not going anywhere. I'm going to be out there in the campaign with her, with Kamala. I'm going to be working like hell.
Here's the latest. An unofficial AP tally has Harris surpassing the number of pledged delegates needed to secure the top of the ticket. President Joe Biden calling into campaign headquarters to offer his support in his first public comment since ending his campaign. Isaac Boltansky at BTIG says this: "We continue to believe it will be a close race, and we maintain our view that Trump is the slight favourite." Isaac joins us now for more. Isaac, let's start with the numbers. Follow the money. $81 million raised in 24 hours. More than $100 million donated to the campaign since Sunday. And yet, your fundamental view hasn't changed. Isaac, why?
So, look, the money that came in for the Harris campaign, I think, is a representation of the relief that's washed over the Democratic Party, given that Biden is stepping aside and they think that they have someone who can prosecute the case against Donald Trump in this election. But our view of this is that we still have probably 7 or 8 different narrative changes between now and November 5th. And when I peel back that onion and I look at the swing states that are going to define this, right, the ones that are going to actually decide this election, and you look at those 6 states, the issues that animate voters the most in those 6 states thus far have been immigration and inflation. And if that's still the case on November 5th, I think that Donald Trump is going to be the next president. The caveat here is no one knows what we're going to be talking about in 105 days. We've got to keep in mind, it was just 25 days ago or so when the debate happened and it reset the entire election. So we're going to have to deal with these narratives changing. And during that time of great uncertainty, I'm just going to keep going back to what animates the swing state voter.
When you look at the issues, this is why a recent poll showed that actually majority of Americans thought Trump's presidency was success versus Biden's. If that's the case, then how does Harris differentiate herself from Joe Biden? He said there he wants to go on the campaign trail with her. Does she want him there?
Yeah, look, I think that in certain places, absolutely. I think that President Biden's going to spend a whole lot of time in Pennsylvania over the next few months. But I think that the Harris campaign, got to get used to saying that now, is going to enjoy some of those contrasts, Anne-Marie. Like, I really think, I don't think there's any example in modern political history of a vulnerability like age becoming weaponized this quickly with the switch in the top of the Democratic ticket. Age was their greatest weakness. It is now the cudgel that they're going to use to push back against Trump. So that's what you're going to hear a fair amount about. You're going to hear the fact that Trump is a convicted felon. The vice president is a former prosecutor. And of course, we're going to hear an enormous amount about reproductive rights, given that that's the one area that you've seen Democrats have success with animating voters in those swing states.
And she's been the face of that for this administration. But beyond reproductive rights, she was a prosecutor, but she was a vice president and a senator. But we haven't really understood what her core values are on a lot of policy issues. What differentiates herself?
Look, at the moment, the way that I'm thinking about this is I'm telling clients that there really isn't much daylight between Biden and Harris. I think that a Harris 1 administration would look a whole lot like Biden 1. there is good reason to believe that Harris is more progressive ideologically than Biden, but this has been a relatively progressive administration the past few years, so I don't see much of a shift there. Furthermore, we've got to keep in mind presidents are often limited by the other side of Pennsylvania Avenue, right? And we still firmly believe that the Senate is going to switch to Republican control. So what can be done there is limited. I do think that there are going to be subtle areas of difference in terms of trade policy and in terms of how they would push forward on the issue of fiscal policy and the expiring tax cuts. But it's all very subtle when you compare it to how Trump would do those things.
Isaac, markets would agree with you, and betting markets seem to suggest that generally people do believe that Trump still has the edge, although it has narrowed just slightly. I am wondering, though, about the bigger issue some people are saying, which is there is new energy in terms of bringing out voters, that potentially that could affect the down ballot races for congressional House and Senate seats. Do you buy that argument?
For the moment, yeah. I mean, look, the most surprising stat of many over the past few months has been the yawning enthusiasm gap when Biden was at the top of the ticket. 77% of Republicans were happy with their candidate. Only about a third of Democrats were happy with their candidate when Biden was at the top of the ticket. You're going to see that normalize, and you're going to see that gap close. And I think that will have an impact on the House races. And this is something that I think is important to hit. The House is going to be close no matter what. That is the reality from the gerrymandered system that we all live in. So the House is going to be plus 10 or 15 seats one way or the other. So it will be very, very close. And in that instance, I do believe that you're going to have an impact from this. And I think that it pushes back against the red wave narrative that we had all been seeing over the past few weeks. I think the House is going to be very, very close. My bet is the House goes whichever way the White House does, but it will be within a few seats.
Isaac, I want to speak to what you're telling your client base, specifically the client base in the investor community. When you put out the note over the weekend following this decision, there's a line that jumped off the page to all of us around this table. You said focus on electability and not policy. Just build on that a little bit more. What have you been telling clients about that?
Well, I think after the disastrous debate performance, I think everyone was trying to parse where the policy differences would be between Harris and Biden, right? And we were all going through her Senate record. We were going back to her actions as AG in California. And I just don't think that there's much value in that because they replaced the top of the ticket on the Democratic side, not because of policy, but because of age and cognitive capacity. Right. And I think that the similarity between Harris and Biden is a feature, not a bug. And so to me, it's just really a question of how she impacts this race rather than the policy substance. So is she able to change the dynamics in Georgia and get voter turnout within the black population, which is unclear that Biden was able to do in Georgia. It's unclear if that would have been there. How is she going to impact women and independent voters in some of those swing states in the Sun Belt? Those are the things that I think matter way more for markets and all of us trying to get our arms around this election than subtle differences between them, between Biden and Harris and their policy perspectives.
Isaac, with that being said, was J.D. Vance the right pick for Trump?
At the moment, it sure doesn't look like it was, right? I mean, I think that hindsight is something that really underscores the humility that all of us should have here. But at that moment, I think that Trump wanted to run up the score with his base, right? He wanted this to run up the score in Ohio and Pennsylvania and Michigan and Wisconsin with white, non-college educated voters. And I think that at that moment, he didn't worry too much about some of the other subsets. And J.D. Vance really does not help you with many other voter groups. And so at the moment, it sure doesn't look like the right one. But I think, Anne-Marie, it really underscores the importance of who the vice president picks as her running mate. And I think that she is going to focus intently on someone that can help her in one of those swing states to broaden the base. That's why you're looking at Josh Shapiro, the governor of Pennsylvania, or even Andy Beshear.
Isaac, thank you, sir. Just wonderful over the last couple of days. Isaac Boltansky there of BTIG. Based on how this race has gone so far, I think we're waiting for that first report about Trump changing his VP, right?
You've heard it here first. Don, do you want to break some news?
You can do whatever you want these days, right? You pick your nominee, you can change it 4 months before.
Maybe there'll be a different Republican nominee.
Come on.
There's not going to be a different Republican nominee.
Coming up, Tesla earnings a little bit later. So yesterday we snapped a 3-day losing streak on the S&P 500, which is quite a strong bounce. Mag 7 leading the way going into earnings for big tech. Equity futures this morning just about turning positive on the S&P, lower on the Nasdaq 100 by 0.1% and up by 0.25% on the small caps. Into the bond market, 2-year, 10-year, 30-year, looking a little something like this, 450. On a 2-year, we're down a single basis point. Later on this hour, we'll catch up with Ian Shepherdson of Pantheon Macroeconomics, and Ian thinks this Fed is going to ease more than you think and more than they think. That's a big call.
And there are a number of people who are kind of lining up behind him. Nick Colas over at DataTrack pointed to 2 New York Fed models that actually put the neutral rate below 1.5%. We're talking about 1.5% versus the current 5.25% to 5.5%. If that were the case, it would suggest what Ian Shepherdson is talking about, a much more dramatic rate cutting cycle that many people are pricing in.
Look out for that chat, that conversation with Ian in just a moment. Switch up the board and turn a page. I want to finish on foreign exchange and look specifically at the strength we're seeing in the Japanese yen. For the second session, dollar yen down to 156.13. All this chat, all this talk, bigger conversations about rate hikes in Japan. We published this story today here at Bloomberg over in Tokyo. Bank of Japan officials see weakness in consumer spending complicating their decision over whether to raise interest rates at a policy meeting next week. That, Lisa, according to people familiar with the matter.
This is the problem that they're grappling with. They're dealing with an economy that does seem to have the inflation that would be required to actually normalize policy rates for the first time in, however many decades. But this is going to be really difficult because if they are seeing weakening trends, how do they justify it now other than just simply saying it's a currency move? Interesting that the market's moving anyway. Because essentially what this is a recognition of the difficulty that they're facing because the yen has weakened to such a degree. And maybe that alone is enough to sort of placate some of the bears in the currency.
Do you think this is speaking to what Mohamed El-Erian was talking about, that the lack of strategic views at some major central banks are leading them to become hypersensitive on one data point, here, there and everywhere? Because if you were taking a strategic view, the recent data wouldn't really matter that much, would it? Just the one hike at the BOJ? Does this really change things?
Absolutely not. When I take a step back, when I talk about the humility and everyone's saying, everyone be humble, well, I'm feeling very humble because everyone's gotten it wrong. And you can make a really strong argument for this market being ready for a resurgence in inflation and this being a pause before something more significant. And you can make a really legitimate argument that we're seeing a real softening patch that's going to just get dramatically worse later into this year. You can make either argument looking at different sectors, and I believe you. So I understand the humility and also the difficulty coming up with the correct construct for some of these central bankers to follow.
I don't know a single person who hasn't been humbled at some point post-pandemic in this business. It's kind of been the business to be humbled. Under surveillance this morning are top stories. Here's the first one. Kamala Harris closing in on the Democratic nomination. An unofficial tally from Associated Press showing Harris surpassing the required number of pledged delegates to seal the top of the ticket. Harris holding her first campaign rally this afternoon in Milwaukee, where the RNC held its convention, Anne-Marie, just last week.
Swing state. She's going to be in and out of this state a lot through the next 100 and so days. What I find interesting about her campaign rally today is not so much Kamala Harris showing up, but Senator Tammy Baldwin showing up. She snubbed Biden recently when he was in Madison, Wisconsin. She wrote a letter a few weeks ago expressing her concerns about Biden being the top of the ticket. If Kamala Harris isn't able to herself win the election November 5th, potentially she's going to help down ballot. And that's what we continuously hear to some of these crucial seats in swing states. They were concerned about Biden ruining their ticket.
This is what we heard from Chris Kruger over at TD as well, when Chris had to say down ballot, good for Democrats. The House and Senate just became more interesting. A GOP wave is still possible, though far less likely without Biden as the nominee. That's down ballot. Let's talk about the race between the likes of Trump and Harris. TD also making this point. I think it's an important one. Can Harris make this a choice between Harris and Trump, or is this still a referendum on the Biden administration, of which she is a major part of and has been over the last 3.5 years?
Well, it depends. And I think it has to do with what voters care about right now. But to Isaac's point, does the narrative start to change? We've seen so many changes this election cycle. As of today, the two top issues remain the economy and immigration. And when you ask voters who do they trust more on those two issues, they go to Trump. So if they're going to vote with their top issue, this looks like Trump has the leeway, and he's ahead on these crucial issues. But she is going to lean hard into women's reproductive rights, which we have seen a winning issue when it came to the midterms.
The reason why this is the reason why I'm so interested to see how Republicans really coalesce around a message to attack Kamala Harris. It seems like there are some kind of counter forces in terms of what to go after her with, and that I think is going to be telling in terms of whether it's a referendum on Biden or whether it's something else.
Big questions, and big question we'll all be asking over the next 4 months or so. Let's turn to a warning from Delta. Trouble for this airline. The airline telling customers to expect more cancellations this week as it tries to recover from Friday's tech outage. Delta grounding almost 4,700 flights in the last 4 days, when most other airlines have resolved their issues by Sunday. This does not look good for this airline, does it?
And first, I just want to say, for all the people who've been stranded, I feel for you, because we've all been there, and it's a horrible feeling, and it's happening en masse with people who are looking for hotel rooms and cars, who have to wait in long lines. This is a disaster. Why? Because this CrowdStrike outage hit their crew organization charts, essentially. So they didn't know where their crews were. Yep. So getting it all together has been incredibly complicated and has been very difficult to get back up to speed. This just goes to show how airlines kind of are dancing on a high wire. On one hand, they're attacked if they raise their prices too much, especially among the rank and file lower income consumers. On the flip side, if they make a mistake, they're on hook for big costs. And Pete Buttigieg is coming out and saying, you got to pay more and do more. And there are complaints that they're not doing enough.
I have to say, Pete's very popular when he comes out and does whatever you just said.
Completely. I mean, that's what everyone wants to hear. When you are left stranded somewhere, say Atlanta, that is a very, very
pictures
frustrating.
from Atlanta.
It is such a horrible feeling.
The videos out there of Atlanta from the last couple of days, brutal. We said this Friday. Biggest difficulty for the airlines once everything gets up and running is finding out where the planes are and where the people are and to get the schedule back on track. Some airlines clearly over the weekend did a better job than Delta. Let's turn to the autos. I want to turn to GM, rising the pre-market big time by more than 5%. Bramo, the numbers dropped just moments ago.
And what I find interesting about this is, why did they do better than expected and increase their full year forecast? Because of gas-powered trucks, going back to what they do best, the GM truck. This, to me, really highlights just how much maybe some of these companies are going back to their roots to really get the earnings that they had previously expected. They earned $3.06 on a share on an adjusted basis in the second quarter. That's up from $1.91 a year ago. So we're talking about UPS going down some incredible 30% in revenues. You're seeing the exact opposite, almost a doubling in income at GM as they adopt a more hybrid model of the sales that they have.
Hybrid, the key phrase there, the key word. That's a company, Mary Barra and GM, they've had to pivot big time over the last 12 months. We'll get Tesla a little bit later. Bloomberg's Craig Trudeau joins us now from London for more on that. Craig, we just had General Motors. To Lisa's point, it's been tricky. It's been tricky for some of these legacy players to make the pivot to EV and then back again to something in between. What are you expecting to hear from Tesla a little bit later?
Yeah, it's going to be very interesting. I mean, just a few weeks ago, we saw, Tesla just narrowly beat expectations for vehicle sales, and a huge move in the stock as a reaction to that. And if you really sort of dug through the numbers, you notice that, my goodness, the consensus really came down in dramatic fashion. I think what we've seen with the earnings estimates is something very similar, where whether you look at revenue or margins or just earnings in general for this company, the expectations, the bar has been lowered in really dramatic fashion. I mean, EPS has roughly halved over the last year. And it absolutely will be interesting to see, how the sort of, numbers are taken, of course. But as we all know with Tesla, more so than the numbers, what really matters is what Musk has to say. And I think what's been remarkable this year is the deterioration in fundamentals for this company that have been just absolutely overlooked the last few months, as Musk has really leaned into his AI messaging, his robo-taxi promises, and that has been effective in really moving the shares and staging this massive recovery.
And the latest is humanoid robots, which also has offered a huge boost to the share prices. You really phrased that beautifully, because it shows how Tesla is not being viewed as a car company. It is a company of hope, of technological prowess sometime in the future that doesn't ever seem to come on schedule. At what point are we seeing that the nuts and bolts of a car company, a true dyed-in-the-wool car company of General Motors, showing the differential between, say, GM and a Tesla that's still riding on a lot of hope?
Yeah, I think it's interesting. You know, I'm reminded just a few months ago when Tesla put out their earnings presentation and sort of alluded to the idea of, you know, many of its competitors sort of paring back their plans for EVs, you know, reinvesting in hybrids or pivoting back to hybrids as GM has, and, you know, Tesla coming out and sort of speaking, you know, taking a stance on its competitors and saying, we believe that this is the wrong call. I mean, I think we're seeing, you know, left and right companies, you know, only adding to those decisions to make that call that, you know, Tesla has come out and criticized. And it does make you wonder, you know, with Tesla, I mean, you wouldn't have thought this would possibly, you know, be within the realm of possibility. But just, you know, this week, Musk has talked about, you know, the need for oil and gas for civilization. I never would have thought, you know, that I would see that, you know, coming off of his, you know, Twitter fingers, I guess not out of his mouth. But he's talked about this idea of, you know, being realistic about, you know, the what's needed in the future, and for you know, him to so dramatically change his messaging to kind of fit with the change in his politics. I think that, of course, will be something that we'll be listening for on the call. Is, you know, to what extent do some analysts press him a little bit about his political transformation?
Craig, can we just take a step back and talk about developments over the last month? We've said repeatedly that the carrot over this stock was the robotaxi business, the announcement we were expecting in early August. And then we had reporting here at Bloomberg, led by Ed Ludlove and the team, that robotaxi announcement wasn't happening in August. And then we sat here waiting for pushback from the company, and pushback that I didn't see. Have we got clarity on when we're actually going to hear from them?
Yeah, we did get confirmation a few days later from Musk that he did ask for a change to the design of these prototypes, as Dana Hole and Ed Ludlow reported. He did not specifically confirm when exactly this event will be staged. I think there's a lot of expectation on the basis of our report that it will slip to October, as we had heard. But of course, I think Musk also is you know, the sort of ultimate showman and likes to really, you know, keep pressure heaped onto his team. So, you know, I think it is an open question whether or not he, you know, within the last few days or week or so has said, you know what, I was going to give you until October, but now it's, you know, September. So that will be something that people are very keen to hear more on. Because, you know, it's not just a matter of staging this event and sort of living up to this hype that he's built up over the last few months, but also, you know, really having something to show in terms of a business plan, you know, taking these from prototype stage to actually building a business. And that's going to be, I think, a lot more difficult than maybe the market is sort of baking in here.
Hey, Craig, thank you, sir. Craig Trudell of Bloomberg, ahead of those numbers after the bell a little bit later. Tesla in the pre-market up by something like 0.75%. That stock has absolutely surged, ripped off the bottom of this year. In April, I think we're up by something like 70% plus since then. I have to say, Elon Musk had a major win, a massive win, Sunday afternoon at 1:46 Eastern Time in Delaware. Why? The president did not address the cameras. He did not put out a statement in the way you might anticipate. It dropped on where? It dropped on X. Of all the places, it dropped on the platform formerly known as Twitter. So we can sit here and talk about Elon Musk and his management of that particular platform. Fact of the matter is, when the president had one of the major political decisions of his career of the last 50 years, he chose that platform.
Which a lot of people are wondering why, for a whole host of reasons. But the bottom line is, if you want to distribute things in mass, that is the way to do it. So you're correct. It's sort of still an open question, though, Anne-Marie, exactly why it was done that particular way.
Open question, and maybe we'll find out today. We will see eyes on the president. We haven't seen him since July 17th. He's going to be leaving Rehoboth Beach just after noon. It was a little bit awkward, though, given the fact that Trump is out there embracing Musk and basically just so excited that he's donating some $40 million a month to his campaign. So kind of weird that Biden would then give Musk a win and make this major historic announcement on his platform.
It's a big win, that's for sure. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Quite a few earnings this morning to get through. UPS sliding in the pre-market, down more than 7.2%. Higher labor costs and soft demand for packages led them to fall short of estimates in the second quarter. It's also grappling with higher costs from its Teamsters union contract, which UPS says would be front-loaded. The shipping giant trimmed its full-year outlook while restarting its buyback program, targeting $1 billion annually. Meanwhile, Spotify also reporting moments ago shares are soaring in the pre-market, up more than 14%. The streaming giant reported big gains in subscriber growth for the second quarter. Paid subscribers grew 12% from a year ago to 246 million. That beat estimates. Even though Spotify has been rolling out price increases over the last year, it's still been able to add subscribers. Its premium plan currently costs $11.99 a month. Spotify has instead focused on cutting costs to boost profitability, reducing its workforce and pulling back on podcast production. Cybersecurity startup Wiz has rejected a $23 billion takeover bid from Alphabet. Instead, the company will stick with its plan to go public. Google's parent company offered to buy it in an effort to catch up with Microsoft and Amazon in a competitive cloud services market. Wiz connects to cloud storage providers like AWS and Microsoft Azure in order to scan for security risks. Alphabet did not immediately respond for comment. The company reports earnings after the bell today. And that's your brief. John.
Hey, Danny, thank you. More from Danny a little bit later this morning. Up next on the program, a tax fight on the horizon.
If you're focused on, what is the platform going to be, call up the House Democratic Ways and Means Committee members. They already wrote this bill and they published it several years ago. And it is, signed, sealed, delivered from the Democratic Party, ready to go to Kamala Harris.
That's up next from New York. You're watching Bloomberg Surveillance. The biggest day of gains of the month on the S&P 500 so far in yesterday's session. This morning, just about unchanged on the S&P. And the bond market, Treasuries rally, yields drop. We're down to 422.71. Under surveillance this morning, a tax fight on the horizon.
So we could talk about Kamala Harris's position on taxes, but frankly, she wasn't on any of the relevant committees to be a tax policy expert, and she doesn't have the authority via the Constitution to write the tax bill in the first place. If you're focused on, what is the platform going to be, call up the House Democratic Ways and Means Committee members. They already wrote this bill and they published it several years ago. And it is, signed, sealed, delivered from the Democratic Party, ready to go to Kamala Harris, where that's the platform she's going to pursue on the tax front.
Here's the latest. Kamala Harris hitting the campaign trail later today, mapping out her economic agenda with Donald Trump's 2017 tax cuts set to expire at the end of next year. Ian Shepherdson of Pantheon Macroeconomics writing this: we assume part of the tax cuts will expire next year, but that the revenue raise will be offset by increased spending. In this scenario, inflation still falls throughout 25, dipping below the target in the second half, prompting much faster Fed easing than either the markets or policymakers expect. Ian joins us now for more. Ian, let's get straight into that. We'd like the numbers. When you say more than the markets and policymakers expect, how much more? What are you thinking about?
Oh, potentially quite a lot. I mean, I think that the Fed is late. They need to be cutting already. They should have started cutting some months ago. I think that the inflation picture is much better than they think. It's going to be way lower than the forecast that they made only back in June. So I think they start in September with 25. Then I think potentially we get another couple of moves before the end of the year, maybe 50 in November and December. And then I think they're cutting all the way through 25. And I think the argument in 25 is, how low do we need to go to prevent inflation falling too far below the target that sub 2% expectations become embedded? So I could easily see them cutting by more than 100, maybe a 150 further in 2025 after cutting more quickly in the second half of this year. So, yeah, we're pretty aggressive on this, but it's really driven by the inflation forecast.
Ian, assuming that part of the 2017 tax cuts will expire next year, assumes that you think you have a sense of the makeup of the White House and Congress. What is their base case to get to this result?
Well, no, I don't have a sense of how it's going to end up. I think anyone who claims to know what's going to happen in November is delusional. But I think you have to assume something when you're making a forecast. So as a starting point, more than 100 days before the election, I think the only sensible starting point is to say that there will be no big policy changes. If by the time the election is much nearer and we've seen a lot more polling, it's blindingly obvious that things are going to go one way or the other, then obviously you have to change your forecast to reflect the most likely outcome. But after the events of the weekend, everything is completely up in the air. It's a week ago, looking at the polling, it was becoming much harder to have an assumption of no change in policy after November, because it seemed quite likely that President Trump would be back in office and that Republicans would take both the House and the Senate. Now, in that environment, you're going to get very different policy. And I was just on the verge of thinking, well, our base case forecasts need to change to reflect this. when we get President Biden announcing he's stepping back and everything changes. So now I think you could generate 100 different scenarios for how things would work out politically. That makes no sense, given that we just don't know. So assuming unchanged policy, that's what drives our inflation forecast and our interest rate forecast for now, but it may well change a lot.
Ian, just from a logic perspective, I'd love your idea on, regardless who wins, the deficit's still a concept that people are concerned about. We're still looking at the indigestion occasionally at certain bond sales. We're still seeing some forecasts that actually inflation will increase as a result of fiscal spending on an ongoing basis, regardless of who wins. Why is that not inflationary? Why do you see ongoing disinflationary even in that environment?
Yeah, well, it was inflationary. With the benefit of hindsight, the stimulus late in the pandemic was too big, and it precipitated a really enormous increase in retail margins, which was a direct push-up on inflation, very substantially. But that's now pretty much over on an incremental basis. Remember, when you're looking at the impact of the deficit on economic growth and inflation, you have to look at the increment, not the level. And the deficit now is pretty stable. It might even fall a bit next year, depending on policy changes after November. But what it's not doing is jumping higher as it did during the pandemic, and triggering that part of the increase in inflation during COVID and afterwards. That element of the inflation story now is greatly diminished. So assuming fiscal policy carries on as it's currently written, which may change, but as it's currently written, I don't see an incremental inflation threat from fiscal policy. I see actually margins beginning to recompress back towards normal. It'll take a long time, but they'll get there eventually. And at the same time, of course, we've got a significant weakening in the labor market. We've got slower wage growth. We've got no real threat from global food or oil prices, and all the supply chain chaos during the pandemic, that's pretty much done as well. So I see a very benign inflation environment, but I can understand why the Fed has been so cautious after the whole transitory fiasco, that they want to be absolutely sure before they start easing. But I think I'm getting close to the point where I think they're too late now.
So, Ian, there are people who are watching this who are throwing things at the screen. And I know because sometimes they call me up after the show and they say, how can people say that this disinflation is going to be sticky? Because what you're seeing in a lot of corporate health pictures is a very strong, robust economy. We just had GM reporting better than expected earnings, record revenues, looking at big sales of major products. How can you say that this sort of disinflation, A, is going to continue when there still is this consumer spending and the pent-up demand, and B, when some people would argue that the disinflation we've seen so far has little to do with the Fed? It has all been simply a normalization after the pandemic.
Oh, I've got some sympathy with all of those views. I want to make it clear, I don't think that inflation is collapsing. I just think it's on a sustainable, substantial downward trend. And let me come back to the point you made about not being due to the Fed. I think that's been true until very recently. But now we're in an environment where actually the lagged effect of the Fed's actions are beginning to kick in. Consumer spending has been much weaker. It's grown in the first half of this year, but at a much slower pace than it grew in the second half of last year. And that's a really material change in the environment. It's not a rollover. I don't have any sort of recession as my base case forecast, but I do have quite a sustained period of significantly slower growth because the interest rate squeeze on the small business sector in particular, and very different to what's going on at GM and in the S&P, but in the small business sector in particular, the squeeze is quite intense. Small businesses across the country employ roughly half the workforce, and they're paying about 9% for their money. It's a very, very aggressive squeeze on them.
Ian, I only got a few seconds left, so just need the number. What's your forecast for unemployment year end?
4.5, 4.75, clearly higher than it is now. Not disastrous and still low, but heading in the wrong direction and telling the Fed to ease.
And much higher than where the Fed think it will be. That's for sure. Ian, thank you, sir. Ian Shepherdson there, Pantheon Macroeconomics. The Fed has got unemployment at 4% year end. The difference between 4 and close to 5, I have to say, that's a big difference. You start pushing 5, you'll get those bigger recession calls from pretty much every single economist on the street.
This is a reason why Thursday's jobless claims actually matters quite a bit, whether it was just sort of noisy that we saw the continuing claims last week rise to the highest levels going back to 2021, whether this was Beryl and some of the implications of the hurricane, or whether this is a gradual and then gradually faster weakening in the labor market.
How much weakness is there? Dow to say things aren't great, and GM says things are pretty good. We'll talk about that in a moment. Up next on the programme, Ed Yardeni of Yardeni Research, Democratic Congressman Jake Auchincloss of Massachusetts. We'll catch up with Bloomberg's Guy Johnson and Jill Carey-Hall of Bank of America from New York City. This is Bloomberg.
We're not changing our election odds. We're not calling for a major market correction. We could see a stalling out of the Trump trade.
Whoever wins, we're still going to have a deficit. We're still going to have high government spending. We're still going to have the same problems that we've had.
Regardless of which party wins, we're looking at big fiscal deficits as far as the eye can see.
We're going to be looking at a different path for inflation under Republicans than Democrats.
The reality is this is a big pocket of uncertainty.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The three pillars of this program over the last month: the politics, the economic data, and now the earnings. Let's talk about the earnings. After the closing bell, a little bit later, big tech kicks off. We're here from Tesla. We're here from Alphabet. This morning, already hearing from these three. And if you wanted a clean read on earnings in America, I can't give you one. GM right now. People are buying trucks. Might not be buying flights, apparently. Not paying up for those, according to the airlines, but they're buying trucks. GM's up by 3.8%. UPS, I think the word you might hear from Lisa in a moment is idiosyncratic. And as for Coca-Cola, the numbers were pretty good in the face of Pepsi numbers, which weren't so good. So, Lisa, those three names, let's make sense of earnings season this quarter.
Well, good luck. I think that what we're seeing right now is that the soft data is as confusing as the hard data, that you can make a story depending on what company you can look at, and then you look at another company, you get a different story. Let's dig into it. UPS has been dealing with a new contract with its union that has really kind of tied its hands and sort of led to a whole restructuring. One of the reasons that they say, actually, we're on the upswing here. They reported a real decline in earnings, something like 30%. That's bad. The shares are down. What you see is in GM, record revenues in the first half. This comes as there are increasing reports about dealers discounting cars and trucks to move them off their lots. Make sense of that. And then Coca-Cola coming in better than expected. Again, it is confusing out there, even if you listen to what the companies are saying.
What a pivot from GM back to the traditional business. The week ahead for earnings. Take a sneak peek of things. This is what it looks like. So you'll hear from Tesla, you'll hear from Alphabet, then the rest of the Mag 7 report. We'll hear from Microsoft next week. We'll hear from Meta, Apple and Amazon. And then the big one, you've got to wait until the back end of August for Nvidia. But that's where the focus is going to be for this market at a time where many people over the last few weeks have been entertained, enticed, seduced by this massive rally in small caps.
At a certain point, it all comes down to the nuts and bolts of what big companies are doing. And what we've heard from guest after guest, we'll continue hearing from more guests this hour, is that the big companies will do better regardless of what happens, regardless of who's in office, and frankly, regardless of how much the Fed cuts rates. If they cut rates a lot, that might help smaller companies, except it means that the economy is in the gutter. And if they don't cut a lot, that means that probably bigger companies have a better go at it than smaller companies. This week, more than 20% of the S&P 500 is going to be reporting. I'm wondering if this is when we actually see the pivot away from the noise to what actually is happening.
The noise on this program means politics, so let's talk about the politics. Let's start with the numbers, though. Since Sunday, in 24 hours, $81 million raised by that campaign for Kamala Harris at a time where the money had completely dried up. Donors had stepped back from the president, Joe Biden. That was the first 24 hours. The last couple of days since Sunday, more than $100 million. AMH has been raised. That's quite a haul.
And 60% of these, it's their first time donation into the 2024 cycle. I think that's what's interesting. People are feeling a little bit of excitement that she's going out to. But donors, obviously, the past month, Jonathan, to your point, they pretty much just evaporated. Because why? No one knew if they were going to be donating to a campaign to nowhere. There's lots of calls for the president to step aside and not seek re-election. So she has this revamp, this restart. A lot of questions remain. She's going to get the nomination. It all looks but likely. They're going to likely bring up the virtual roll call, so they go in with a ticket to August 19th. But how does she reestablish herself? And because she's attached to Biden, is that going to work with swing state voters where we see Trump is ahead?
Well, let's talk about Biden. There's still some governing to do. So he can step back from campaigning. He's got to lean in to foreign policy. The Israeli Prime Minister is here this week, and there are conflicting reports, let's say, about when they're set to meet, because we still haven't seen the sitting president since, Las Vegas, Nevada, last week.
July 17th, the last time we saw him leaving Air Force One when he was going to depart to Delaware for isolation. And he's been in isolation since. So we will see him today. His schedule says he is set to come back to the White House. Netanyahu's team said the meeting was supposed to be today. Because of this COVID, it's been postponed. We're hearing that it's going to be on Thursday, which means likely tomorrow, because before he sits down with Netanyahu, he needs to address the American people. Because the American people found out the sitting president is not seeking re-election through a letter. not through an address to the American people. And there's a lot of questions about that. Why was that done? So before he sits down with Netanyahu, he's going to have to get in front of a camera.
I will just say that Netanyahu is also meeting with Kamala Harris in a separate meeting. And this comes at a time when there's a real question, to your point, John, about who exactly is going to be pulling the strings from here until November.
There's some real governing to do over the next 6 months, that's for sure. Let's turn to the price action. Equity futures on the S&P 500 positive by 0.1%. Let's get into the bond market. Treasuries rallying. Yields are lower by 2 basis points, 422.91. And the dollar snapping back. A bit of dollar strength against the euro. 108.62 on euro dollar. We're negative there by about 0.25%. Coming up this hour, we'll catch up with Ed Yardeni of Yardeni Research following the S&P 500's best day since early June. We'll speak to Congressman Jake Auchincloss as Harris strengthens her hold on the Democratic ticket, and Jill Carey Hall of Bank of America on the bullish case for small caps a little bit later this hour. We begin with our top story, the S&P 500 snapping a 3-day losing streak as investors reassess election risks. Ed Yardeni of Yardeni Research writing this: a second presidential term for former President Donald Trump still looks likely. For now, the financial markets are uncertain as to how to prepare for Trump 2.0. Ed joins us now for more. And Ed, to make it even more confusing, you say there is more than one consensus. So you're going to have to explain that to me. How can there be more than one consensus?
Well, I think there's several financial markets, and among the financial markets, there's different views. For example, in the commodity markets, there's quite a bit of weakness in copper prices recently. There's quite a bit of weakness in the oil price. The oil price has been remarkably subdued in the face of all the geopolitical risk that's out there. On the other hand, the stock market suggests that things are just fine. Now, I think some of the differential is that the commodity market is probably looking at things more globally, whereas the stock market, especially if we're looking at the NASDAQ S&P 500, is looking at things more locally. So I think that's part of the divergence. Even in the fixed income markets, we have some divergence. The Fed funds futures market is looking for something like 5 rate cuts over the next 12 months. And yet the bond yields held up remarkably well, around 4.2, 4.25%. I don't think they've been discounting the possibility of 5 rate cuts the way the Fed funds future has been discounting. So a lot of opinions in the financial markets all over the place.
So, Ed, given the fact that we have 3 different asset classes that you've just identified with 3 very different characteristics, do you think those 3 worlds can coexist?
Well, I guess the answer is something's got to give. I mean, there's only going to be one scenario that unfolds, and I think the scenario that's going to unfold is really more of the same. I think that the global economy is kind of muddling along. It's hard to get very excited about anything happening in Europe. The Chinese economy looks downright weak. I think they still have a property depression that they just can't seem to really offset with easier monetary policy. Just yesterday, they lowered their interest rate, and the price of copper went down. So that was not a real vote of confidence in the government's ability to deal with the Chinese weakness. On the other hand, there's no recession in the U.S. The U.S. looks absolutely fine. The latest Atlanta Fed reading on GDP is 2.7%, which is very good. And inflation's moderating. So it's an ideal scenario for the stock market.
The Roaring 20s come back. Ed Yardeni, you were one of the first to talk about the Roaring 20s. A lot of people have gotten on that boat and actually met you at some of your forecasts, which you even brought forward as we've seen markets increase at an accelerating rate. At this point, there is so much disagreement about whether there can be a broadening out in this kind of rally, or whether ultimately the blip that we saw over the past couple of weeks in big tech, in some of the growth stocks, is a buying opportunity to double down because those are going to be the winners no matter what.
I think they are going to be the winners no matter what, but I don't think that they can be sustainably the winners unless the market does broaden out. It's my pet theory that in the Roaring 2020s, every company is a technology company. They either make technology or they use technology to increase their productivity. There is still a significant shortage of skilled labor out there. There's a lot of technologies that can boost productivity, cut costs. And if you don't use those technologies and your competitors do, you'll be simply out of business. So I think I think we started to see the beginning of a productivity growth boom last year. I think it continues through the end of the decade. I think margins go up. I think profits go up. I think the stock market goes in that kind of scenario.
Given that as your base case, Ed, how do you interpret a very different view, company from company, when we get earnings, of what's going on in the bottom line? You've got UPS talking about falling package volume in the United States, falling revenues. You hear from the airlines, their hands are tied in terms of how much they can increase prices. We've heard that from some snack food company, Coca-Cola, not among them. How do you understand some of the differing messages depending on which company you look at?
Well, I think you I certainly look at the individual companies and try to start from the bottom up and see how that all adds up. But at the same time, as an investment strategist, macroeconomist, I also do the exercise from the top down and kind of see where they meet in the middle. What I see is overall earnings are growing in line with an economy that's doing fine. Analysts are expecting earnings to be up 8% on a year-over-year basis during the second quarter. I think they're going to come in at 10 to 12% on a year-over-year basis. Same thing happened in the first half of the year. Analysts were too conservative on earnings growth, and that's one of the reasons that we had such a strong stock market in the first half of the year. I see signs that the goods economy is bottoming. We've had a rolling recession in the goods economy, as we've seen, for example, the purchasing managers' indexes. But I think we're going to find that things are starting to improve in that area as consumers start buying goods again.
Interesting.
Still buying services, though.
Ed Yardeni of Yardeni Research. Again, apparently just not paying up for flights, which I'm still struggling to get my hands around. Ed Yardeni there of Yardeni Research on the latest. I'm still struggling with that one. The airline's saying, capacity's gone up too much. Flight costs have come down. And then we see the scenes in Atlanta, which I know are to do with all the cancelled flights, but these planes have been packed all summer. And I didn't see a real identifiable drop in ticket prices, that's for sure.
Not when you look at certain popular routes. But then when you look at certain domestic routes, that's what people are saying. And you actually do see this when you look at pretty esoteric cities. I'm not going to go into which ones. You can see the prices go down more significantly, or at least not be as, through the nose expensive.
You can share that in the commercial break. Equity futures on the S&P just about positive by almost 1/10%. Let's get you an up-to-date on stories elsewhere with your Bloomberg brief. It's Danny Berger. Hey, Danny.
Hey, John. Some more earnings to go through for you. GM shares are higher by 4.6% in the pre-market. They topped forecasts. Profits surged 60% from a year ago, thanks to demand for its gas-powered pickup trucks and SUVs in the U.S. On the other hand, there was a slowdown in sales growth for EVs, which are losing money at the current volumes. It does highlight a pivot back away from EVs and tech-fueled growth into a gasoline-fueled cash generator. Shares of Coke, they are slightly higher in the pre-market, 1.1%. The soft drink company raised its full-year guidance. It also reported comparable earnings per share for the second quarter that beat estimates. The company says it was encouraged by its results in a, quote, ever-changing landscape. Coca-Cola's results come in contrast to its rival Pepsi, which reported weaker than expected revenue and tempered its annual outlook earlier this month. Now, General Electric reporting a jump in second quarter profit, those shares up 2%. It also raised its guidance for both cash flow for the year and profit. The jet engine manufacturer capitalized on strong demand for the busy summer travel season, so figure that one out. It also became an independent company in early April, now GE Aerospace. It was able to navigate consistent turmoil in the aerospace supply chain, responding to strong demand for maintenance and spare parts as aircrafts age. And don't miss our interview in the next hour. Larry Culp, GE Chairman and CEO. And that's your brief, John.
Danny, thank you. Must-watch conversation with Guy Johnson a little bit later on in the program. Up next, Democrats charting a path forward.
Vice President Kamala Harris has excited the community. She's excited the House Democratic Caucus, and she's exciting the country.
And the money over the last couple of days has followed. From New York, that's next. This is Bloomberg. Live from New York City, welcome to the program. Let's start with equity futures on the S&P 500. We're shaping up as follows on the S&P. We're a little bit firmer off the back of the best day of gains on the S&P 500 since early June. Yields on a US 10-year look a little something like this going into supply later on. Your 10-year at the moment in the Treasury market, yields are lower by 2 basis points of 4.23. That's the equity market story. Let's get to the earnings a little bit later. We'll hear from the likes of Alphabet and Tesla after the closing bell. Those two, the starting gun for the earnings from big tech over the next week or so. The next week looks a little something like this. Let's go through the next week and look at the likes of Alphabet. Later, onto Amazon and Microsoft next week, Meta, Nvidia. Just a fantastic lineup of earnings, Lisa, coming up over the next week or so.
The question is, can this shift the conversation past the three pillars, the two pillars that we've been talking about obsessively, being the politics, which has dominated a lot of the conversation, and the economic data, which does show a gradual weakening, but not necessarily an economy falling off the cliff. What we have seen so far is pretty good. We have later in the show today an analyst coming on who says that a beat is basically just a meet. That if you see a lot of companies meeting expectations, that will increasingly be viewed as a beat at a time of reduced expectations.
So let's talk about some of the earnings we've had already. Can we get the pre-market movers up? Let's check out the pre-market movers that we've seen so far. So we've heard from the likes of UPS, heard from them a little bit earlier this morning. We heard from GM, General Motors, in the last hour as well. We also heard from Coca-Cola. And let's compare and contrast the likes of Coca-Cola to, say, a Pepsi. Coke was pretty decent, Lisa. We've been talking about Pepsi over the last couple of weeks, about a consumer struggling, backing away from snacks. Then Coke reports this morning, and you don't see a big problem at all. The name is up by about 1%.
Net income going to 56 cents a share from 59 cents, falling just slightly, but still adjusted earnings per share beating the forecast pretty much across the board and having a more positive kind of view of the world. What we're seeing, and I don't want to say idiosyncratic, but let's say idiosyncratic, are specific stories that are either coming to roost in a good way or a bad way. UPS, bad way, costs, some of their new union contracts really eating into their profit revenues. GM, their pivot back to gas-fueled trucks, really helping to support record revenues for the first half of this year.
The tone for this earnings season, it didn't start well. It started with Delta. And Delta reported about something I don't think we'd thought about this summer, because we'd all seen the airports in this country absolutely packed. They talked about additional capacity, at a time where we couldn't secure enough Boeing airplanes, and they talked about lower ticket prices. I want to cross over to Bloomberg's Guy Johnson, who's at the Farnborough Air Show. Guy, I want to understand about the capacity issues that some of these airlines are struggling with at the moment, and whether that could get worse if Boeing actually gets the job done and starts delivering planes in a much faster way.
Well, you've got to remember as well, John, that the airlines are flying a lot of older aircraft. So if they can start getting the newer aircraft in, they'll just kind of replace much of that one for one. So they'll retire some of the older aircraft that we're seeing. If you want evidence of the older aircraft that are currently flying at the moment, A, take a look at Delta, which flies one of the oldest fleets out there, which is interesting in itself. But B, take a look at the GE numbers this morning. They crossed the tape a little while ago. There's a beat and a race from GE. I'm going to be talking to Larry Culp very soon. One of the reasons why Larry Culp is seeing the strong numbers that he is at the moment is because the maintenance business is so strong. That is a super high margin business, spare parts and maintenance. And the carriers are flying very old aircraft right now, and that is boosting his bottom line because they need to come in the shop, they need to have extra parts, and that is really helping him out right now. So yes, in some ways, we are seeing older aircraft continuing to fly. That's good news for GE. If Boeing gets its act together and is able to start delivering some of the narrow bodies in particular, then I think you'll see a lot of these airlines bringing those aircraft in relatively quickly, but it's unlikely to happen this summer. It's too late for this summer. You want to bring aircraft in at the beginning of the summer. You don't want to bring them in midsummer. So this will be a story for next year.
Guy, I do want to get your view on why we're hearing such different messages or conflicting messages from the airlines. But before we go there, you're talking about Larry Culp, GE benefiting from the fact that older planes are being flown. And then this question of whether Boeing can get its act together. Will Boeing tap Larry Culp to get themselves together?
No, that's not going to happen. Larry's just continued his contract. He's going to be at GE until 2027. So that ship maybe has sailed from a Boeing chairman point of view. He's not on the list, it seems, for that Boeing job right now. I'll ask him about it, ask him why he's decided to continue at GE. But he's managed to turn this business around. Remember, Lisa, this is a company that spun out a lot of its component parts, the GE business, the core business, the jet engine business. Remember, this is the largest jet engine business in the world, is now a standalone business. This is almost kind of a new business that we're seeing on its own right now. And it looks like he's probably going to continue at GE for some time. As I say, the contract has just been renewed. Looks like Boeing and the recruitment team at Boeing are going to have to look elsewhere for a candidate. So GE continues. And today was a beat and a raise. So he's obviously managing to deliver what he's promised and set out for shareholders. Looks like the stock's up a little bit pre-market. We're waiting for the call.
There are a lot of people who are listening to you and saying, nah, he's still going to be the guy, because that's what everyone has been saying. We say, who would actually be the person to run it? And they say, Larry Culp and only Larry Culp. Moving on to what we're seeing right now in the airline industry, can you give us a sense from the tone on the ground at the show you're at about why we're hearing from airlines that they don't have the same kind of pricing power and that they're concerned about filling their flights, at the same time that our just empirical evidence seems to suggest that flights are completely packed and it seems like people are traveling as much as ever?
So there's two things going on, one of which is the long-haul business, I think, is still relatively strong. I've spoken to a number of the long-haul carriers over the last couple of days. The message from them is certainly that they are continuing to see strength. If there is weakness, it is at the narrow body end, the short haul end of the market. That's where probably there is greater capacity. That's where you've obviously got business models that require high yields, i.e. full aeroplanes. And that is where the legacy carriers, let's call Delta a legacy carrier, is having to compete with the likes of Alaska and the lower cost carriers as well. So that's where the real competition is right now. So if there is a crunch point, that's where it is. And you've got to remember as well, so you look at an airline like Delta, as I mentioned, it's flying an older fleet. That means in some ways that Ed Bastian has a lot of amortized aircraft. He's already paid for those aircraft. In some way, he has the capacity in those markets, therefore, to lower prices and maybe be a little bit more dynamic in terms of his pricing, because the aircraft are paid for and he doesn't necessarily have to keep fares as high as he would have done. But that's where the real crunch point is. That's where the competition is. And it was interesting to see Ryanair as well, maybe suggesting that similar things maybe are happening in Europe, though it does seem actually as if what Ryanair was saying, you look at the back end of the statement, that demand is still very strong. It's just kind of a pricing factor. So there is a little bit of a capacity story in Europe as well. And we'll see how that story develops.
Guy, I also noticed that this air show is not immune to U.S. politics. Glenn Youngkin was there. You sat down with him yesterday. Donald Trump calls him prime time. Is there a sense that CEOs are trying to get ahead of the U.S. election and get in front of each camp? And who are they betting on?
Well, uncertainty was a word I heard a lot, certainly yesterday and continuing again this morning. I spoke to Guillaume Faury. He's the CEO of Airbus, and he's kind of hoping that the Alabama plant that he's got will be able to insulate him from potentially a tariff story. So everybody's talking about tariffs and the potential for tariffs. Remember, this is an industry that has been upended by supply chain issues. You throw tariffs into the mix as well, that could only compound that issue and make it more difficult to manage. But a lot of these big manufacturers, the OEMs, the tier one suppliers like GE, Rolls-Royce, they are reasonably geographically diversified. So maybe that doesn't become a problem. But the uncertainty is absolutely huge as well. The other factor, Lisa, is what's happening on the defense side. Take a look at what is happening with GE this morning. A little bit of weakness maybe there. If Trump comes in, we get a 2.0, does defense spending start to creep higher?
Hey, Guy, looking forward to this conversation later. Bloomberg's Guy Johnson sitting down with Larry Culp of GE. The first question, do you want the job at Boeing? You know, it's not going away, is it?
No,
it doesn't matter what Guy says.
Guy's like, he doesn't want the job. You think anyone's going to say, okay, I guess he's not in.
So do you want the job? From New York, that conversation later. This is Bloomberg.
Give me the right answer.
Live from New York, welcome to the program. Here's the equity market. Futures just about positive by, let's call it, 1/10% on the S&P. That's stocks. Switch out the board and get to the bond market. We'll check out treasuries. Yields look a little something like this, down 2 basis points on a 10-year. Your 10-year 4.22. 91. And in foreign exchange, a little bit of yen strength going into the BOJ meeting in the next month. Big conversation about whether we'll get rate hikes or not. Dollar yen down to 156.10. We're down about 0.6%. That's the price action. Here are your top stories. Under surveillance this morning, CrowdStrike CEO George Kurtz is being called to testify before Congress following the defective software update that caused a global IT outage. A House committee asking the company to promptly schedule a date. Your next story. Tech earnings kicking off after the closing bout today, starting with Alphabet and Tesla. Analysts are likely to focus on the Google parent company AI revenue, and also pressing Tesla for answers about the delayed robo-taxi rollout. Look out for that this afternoon. And Harris's campaign finally receiving more than $100 million in donations since Sunday, as an unofficial AP tally shows her securing enough delegates for the Democratic nomination. Speaking at her campaign headquarters, Harris saying, "I am proud to have secured the broad support needed to become our party's nominee. I look forward to formally accepting the nomination soon." To have that discussion now, I'm pleased to say that joining us, Democratic Congressman Jake Auchincloss of Massachusetts. Congressman, great to catch up with you, sir. You've been a big supporter of the president. You weren't one of those that came out and asked him to stand down. You were one of those who highlighted the success he's had, his track record over the last 3.5 years, which makes me wonder how confused you might be that given how good you think that track record has been, why people within your own party has forced him to step aside.
Good morning. Thanks for having me on. General elections are won or lost when the terms of the debate are set. And the terms of the debate previously were the president's age and acuity. Now, with Kamala Harris having taken the torch, the terms of the debate are the future versus the past, our rule of law versus the law of the ruler, our Donald Trump's obsession with the grievances of the past versus the possibilities of a strong American economy. These terms of debate, Democrats will win.
Congressman, do you think it was appropriate, though, that the president told the American people through a letter, and we've yet to hear him address the American people? He's a sitting president. We haven't seen him since July 17th, and he has yet to give remarks to the nation about why he is stepping aside.
The president laid out his decision in a thoughtful and well-crafted letter, and then he's going to address the nation this week, I believe. And I think he is going to do what he has always done, which is put the country's interest ahead of his own, which is a stark contrast to what we have seen from Donald Trump, who rather than cede power, clung on to power, incited an insurrection, and caused the deaths of officers in the line of duty. That contrast will not be lost on the American public.
But at the moment, there's a lot of questions surrounding why we have yet to see him and decided to do this through a letter. Is it your understanding that if he didn't drop out this weekend, more of your colleagues in Congress were going to come public with their concerns about his age and mental acuity?
I don't think conjecture about the past is particularly fruitful right now. We have our nominee. It's Kamala Harris. I think the focus now is how do we sprint through the next 100 days to win this election? Because the contrast now is going to be on Democrats as the party of the rule of law. As Americans intuitively understand, without predictability, without law and order, we cannot thrive as an economy and as a civil society. The Republicans have nominated a convicted felon. The Republicans are trying to surge guns onto our streets and in our schools. The Republicans are voting against bipartisan border security legislation. The Democrats are the ones that the American public can trust to uphold the rule of law, and that will be the conversation.
Does this to you look like basically a coronation, though, of the vice president? The Wall Street Journal editorial board this morning talked about that the country's now losing the chance to see a genuine and instructive party debate unfold. She is winning by acclamation among all of the Democratic Party insiders and money men who've swung behind her. How concerned are you that this looks like a coronation of vice president and not like a democratic process?
I like competition. I like competition in business. I like competition in politics. And I think the Democratic Party should not be afraid of it. And we should have an open and transparent process to choose our next nominee. But Kamala Harris can't help it if everybody endorses her and she gets the majority of the delegates within the first 24 hours and she sees a surge of base support. I mean, she's going to compete hard. She said she was going to earn it and win it. She's earned it. She's going to win the nomination. And now we have to make sure that she wins the general.
Congressman, I think the way to put this together is there's this question of how can the Democrats be the party of democracy if they bet on a president to run again and just months before the election date, he was pushed aside and somebody else was brought in. It raises questions about the Democrats' view on the democratic process of election. How do you counter some of those real concerns that people have?
I think that's a flawed premise. I was here in the chamber on January 6th. I've seen what a coup looks like. What happened here was the Democratic Party is designed to win elections in order to effectuate policy that helps American voters. Joe Biden, through 14 million voters, won the delegates. He then decided, I'm going to step aside. Those delegates were unbound. They were free to choose whomever they wanted to carry the torch, and they chose Kamala Harris. That is exactly the way that delegates are supposed to happen under Democratic Party rules. Now, voters are going to see a choice between Kamala Harris and Donald Trump. They will have the final determination of whether they like that choice. And I am confident that since 70% of Americans previously said they wanted a change at the top of both tickets, and only Democrats have responded by actually doing it, that they're going to choose Kamala Harris.
Congressman, there's also a lot of concern about what people don't know. And I think that that's what the debate really highlighted for a lot of people. What aren't we seeing about the state of the current president, who still has to rule until early next year, regardless of who wins the White House? At what point can you truly allay those concerns at a time when we haven't seen him, and there is this fear that, you know, it's something more that caused him to withdraw than simply pressure that has been mounting for a while and that he was pretty defiant in the face of?
Well, I mean, I know a few days is an eternity in the media, but we actually have seen him a lot over the last month. We saw him on the debate stage. We've seen him do one-on-one interviews. We've seen him at rallies. And most importantly, we've seen his track record over the last three and a half years. This president took an economy that was flat on its back, and we now have strong jobs and inflation numbers. This president has restored U.S. global leadership. This president is protecting civil rights and democracy at home. Americans can see the track record, and Americans like the policies. And that's what Kamala Harris is going to be able to run on now, is we've put the age and acuity issue to bed. We have the policies front and center. We have a dynamic candidate, and we're going to win.
Congressman, you just said that they like the policies. Can you point to the polls where that really shows up?
Medicare negotiation of drug prices, investing in infrastructure, the CHIPS and Science Act to turbocharge our competition against China, Electoral Count Act reform to help close the January 6th loophole, Bipartisan Safer Communities Act that has helped push homicides.
Yeah, that's a long list of issues. You're right to point them out. That's been a successful part of the administration, but he was behind in the polls to such an extent, the leadership within your party pushed him off the ticket, Congressman. I just feel like this conversation at the moment feels like we're in two different realities. You just then made it about the news cycle. Let me just finish up. I felt like that was needlessly snarky, sir. This is not about the news cycle. This is about the sitting president of the United States that chose to make one of the most consequential decisions of his career on Twitter on Sunday, and we've not really heard from him since. And I find it odd that you don't think that's strange.
It's Tuesday. He issues a letter on Sunday. He's going to address the nation. He laid out his reasoning. This country over the last 250 years has seen some of its most consequential moments described in print. There is nothing that's an affront to the American public about laying out in black and white text his reasoning. He will address the public, and most importantly, he has demonstrated to the public over the last 3.5 years that not only can he be president, but he can be a top 10 president in American history.
So why isn't he running?
He isn't running because the concerns about his age and acuity are undermining his ability to beat Donald Trump and undermining the constituents' confidence that he can discharge the duties of his office 4 years from now.
But they're the concerns that your colleagues have, correct? That's come from within your own party. That's not like something that's come from the media. It's officials, peers in your own party.
And I've been very clear about that. The concerns are organic.
If they don't believe the policy is more important than his age, I've just really struggled here. You've come out a few times, and I've seen some of your comments previously, and we keep going back to this track record, the policies, the last 3.5 years. Don't you think if the public thought those policies were that good, we wouldn't be in this position to begin with?
No, because the public was focused on the president's age and acuity. We now have a different candidate at the top of the ticket, and elections are about the future. And what we are going to say to the American public is, look at what we have accomplished over the last 4 years. Let's take this forward as we debate tax policy in the next Congress. Let's take this forward as we debate immigration policy in the next Congress. Let's take this forward as we debate reproductive freedom in the next Congress. And let's demonstrate that we can make this economy work for everybody. Let's demonstrate that we can continue to heal our democracy after the depredations of the Trump administration. And all Trump is going to be able to say is that same spew of grievances and self-pitying and egocentric lamentations that we heard from his convention speech, where he tried to go for 20 minutes and sound statesmanlike, and he couldn't get past 10.
Congressman, if it's your own colleagues, the elder states, individuals, if you will, of your your leaders, Pelosi, Schumer, all of these leaks, if they're the ones that are concerned about his age and mental acuity, then should the president step aside? How can the American people be confident that he can fulfill his duties for the rest of his term?
He absolutely should not step aside. This president is fully able to be commander-in-chief. We've seen him walk a tightrope in the Middle East, protecting the security of Israel while not allowing for a regional conflagration. We've seen him rally NATO to Ukraine's side. We've seen him bind together South Korea and Japan and the Philippines and Australia to help counter Chinese belligerence in the Indo-Pacific. This president is a highly successful foreign policy president who has also implemented monumental domestic policy legislation. He has demonstrated he can do the job. He's 81 years old. Voters had concerns about his ability to do the job for 4 more years. Democrats listened. Democrats put forward a younger, dynamic candidate. And now the Republican Party is going to have to explain why they're not doing the same thing. Because 70% of Americans wanted a difference at the top of both tickets, and Republicans responded with a mosh pit in Milwaukee.
Congressman, appreciate the stern defense. Thank you, sir. Congressman Jake Auchincloss there on the latest out of Massachusetts, a stern defense of the President of the United States. And some of the comments I think you heard there, you're going to hear that a lot on the campaign trail over the next 3.5 months.
Absolutely. Republicans are already saying if Biden cannot seek re-election, then he should be stepping aside. And there's a lot of concern, actually, that we haven't seen him for almost a week. It was July 17th. That was last Wednesday when he stepped off Air Force One, went into isolation in Delaware. There was this phone-in to the Harris Now campaign headquarters in Wilmington yesterday. But we have not seen him on camera. And the reason why this is concerning is because he ran an entire election on camera. This was during the depths of the pandemic when people were zooming in. So we have seen him take to his house to hit the airwaves. Why did he decide to do this via a letter?
We will be hearing from him, presumably, or seeing him today. There is also this question of, is this going to be really an election about age? And if it's going to really be the case, can the Democrats pivot this around Donald Trump and say now he is the oldest candidate ever to run for president and he needs to take a mental acuity test, et cetera, et cetera? You see how this goes. It goes to beautiful, wonderful, dirty noise.
Well, I think it was Nikki Haley earlier this year who said whichever party dumps their 80-year-old candidate is the party that's going to win. That was from Nikki Haley, who wanted to be the top of her Republican ticket. She didn't get the nod. But now everyone is just replaying that sound because the Democrats are the one to dump first their 80-year-old.
Things can change again. They've changed a lot over the last month, that's for sure. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Danny Berger. Morning, Danny.
Good morning, John. Israeli Prime Minister Benjamin Netanyahu says prospects for a hostage deal with Hamas are improving. Netanyahu spoke while in Washington. It's his first foreign trip since the conflict began almost 9 months ago. Netanyahu is scheduled to meet with President Biden on Thursday, 3 days later than originally planned because Biden has been isolating with COVID-19. The first ETFs investing in Ether will make their trading debut today. Regulators have approved spot Ether ETFs, according to filings and statements from asset managers that paved the way for the imminent trading. It's yet another landmark for this ETF industry after spot Bitcoin funds debuted in January. Several issuers like BlackRock and Fidelity are partially or completely waiving fees to try to attract assets. However, analysts do expect that Ether won't draw as much demand as its Bitcoin counterpart. UPS shares, they are sliding in the pre-market trade 7.7%. It reported profit that missed estimates amid heavy costs and uneven demand. Their hyper labor costs, soft demand for packages, and that led them to fall short of those second quarter estimates. Now, it's also grappling with high costs from its Teamster union contract. UPS does say that those costs will be front loaded. The shipping giant also trimmed its full year outlook, and it's going to restart its buyback program, targeting $1 billion annually. And that's your brief, John.
Hey, Danny, thank you. We'll catch up with Danny again in about 30 minutes' time. Up next on the program, the great rotation debate.
There has been a technical rebound, likely driven by sentiment positioning for small cap, but we're not chasing that momentum because that rebound is not supported by fundamentals.
We'll get you the bullish view on small caps up next on the program. Live from New York, this is Bloomberg. You want to continue that conversation?
Please, let's not. Let's leave that there.
Equities. Let's get to stocks. It's always a safer place. On the S&P 500, positive by 0.05%. Yields are lower by a basis point or two. On a 10-year, 423.49. Under surveillance this morning, the great Rotation debate.
When it comes to earnings, small cap, for over 1 year now, they didn't deliver any earnings growth. For this ongoing earnings season, they're expected to recover a little bit, but still really lag in the broader picture. There has been a technical rebound, likely driven by sentiment positioning for small cap, but we're not chasing that momentum because that rebound is not supported by fundamentals.
So here's the latest. Small cap stocks looking to bounce back after coming off their biggest 2-week rally in years, with earnings season ramping up. Jill Carey Hall of Bank of America writing this: we still think pockets of small caps are poised for continued outperformance. Be selective near term. Focus on value stocks where we'd still stick with quality or profitable value. Jill joins us now for more. Jill, good morning. This is your turf. This is your world. So let's get straight into it. Small caps. When I buy the Russell, what am I buying and why should I be buying it at the moment?
Well, I think, we had gotten more cautious on the Russell 2000 as an index back in April when the inflation data had continued to come in stronger. And, really we highlighted there was two things that we need to see to get more bullish on the Russell as an index. And one is, more confidence that the Fed will be able to begin that cutting cycle, which now is what we've started to see and what was a big driver of the rally we've seen over the past week or two. I think the other is fundamentals and profitability. And that's where, the Russell does have a high proportion of unprofitable stocks. It saw a much bigger earnings recession than the S&P 500. And that's where I think investors are a little bit worried, because when you look at the beginning of the year, investors were expecting that by this earnings season, small cap profits would have come back, recovered, been better than large cap profits growth. And that's not what we've seen. We've seen a lot of hope held out for fourth quarter of this year, a very strong recovery, but the first, second, and third quarters of this year, estimates have gotten revised down significantly. So I think that's what, we really need to see if we want to see if this rally is sustainable is, can we get good earnings data this earnings season, not only surprises to the upside, but guidance that supports that the fundamental backdrop is healthy for small
So let's pick a sector, a dominant sector on the Russell, the financials. We can talk about the financials. The regionals have been a big part of the story now for the best part of 12 months. We've had a big rally there. Do you think there's reason to believe earnings will pick up and reaccelerate as we start to cut interest rates at the Federal Reserve, that things get better for that cohort of companies?
Right. Yeah, financials has definitely been a big leader of the rally recently. And certainly, if we see an outlook where we're looking for Fed cuts, where we're looking for soft landing, no significant deterioration in the economy, that should be supportive for financials. I think, when you look at factors like the regionals and credit conditions, that's still a risk that's out there. So, if we're in a backdrop where the Fed's cutting because economic conditions have deteriorated significantly, credit spreads are rising, that would be more negative versus a backdrop where the econ is still supportive. But certainly for financials, I think we've been due for a catch up, especially within small caps. Looking out, I think we still would be more cautious on some of the regionals, and it's an area where you want to be selective in relative to the large caps, which, large caps already got regulated. They saw their multiples contract for a number of years after the financial crisis. Regionals still could be subject to that. If we see greater focus on some of these regional banks that haven't had the regulation that the larger SIFIs have.
There's sort of a tortured relationship a lot of investors have with these names, just simply because they have gotten so beaten up that on a valuation perspective, they look great. And then you look under the hood and you start to see a lot of concerns. One of these numbers, I'm talking more generally, not just the financials. More generally, you put this out, that only 13% of second quarter reporters of small cap companies have beaten on earnings per share in sales. That compares to 51% of large caps. Can you give us a sense of why? Why smaller companies are struggling to really meet some of the expectations, even as large caps continue to outperform?
Yeah, it's been still pretty broad-based, where just that overall profits recovery has been much, much slower to come to fruition in small caps. And the earnings decline was pretty much across the board. And when you look at second quarter expectations, pretty much most sectors are expected to still see negative earnings growth this quarter. So, smaller companies have been more challenged. And when you look at the large caps, obviously a lot of the Magnificent Seven, some of the big tech stocks have been the drivers of earnings growth. We do expect that to slow and see a broadening out to the rest of the other 493 of the S&P 500. So it's a similar story for small caps, but a lot of these smaller companies companies have still been challenged. You've had less profitable companies within the index. You've had sectors like healthcare, where that's been one of the sectors that saw the biggest decline, and now is expected to see among the biggest recoveries. So I think when you're thinking about buying the fundamentals of these companies, that's why we've been still more cautious on the overall index. But I think in pockets of small caps, there's still a lot of opportunity. And as you pointed out, the valuation backdrop, the positioning backdrop is very supportive. Investors have been very underallocated to small caps. We've seen investors want to get more bullish on small caps. They've been such a laggard for such a long time. So I think the areas that are perhaps less sensitive to refinancing risk, if there's still some uncertainty on the Fed, could be a good area. Areas that are sensitive to still cheap but have positive estimate revisions if we're in a backdrop where that's still uncertain.
You went to the area that I wanted to go to. There's three pillars of economy, earnings, and politics. We're focusing on the first two. We've talked about earnings, but what is the read-through to the economy? This question of small caps ostensibly have more floating rate debt, are more sensitive to perhaps higher rates by the Federal Reserve. Is that a key reason why you're not seeing earnings increase at a faster pace akin to some of the larger companies that were able to lock in some of those funding costs that were really cheap earlier on?
Right. Yeah, I mean, small caps definitely have a lot more, as you pointed out, floating rate, short-term debt. Almost about half of their debt falls into that profile, whereas large caps, about 80% of their debt is that long-term fixed rate debt. So, I think the fact that we've seen inflation start to come down and the Fed could be on track to begin cutting rates. Our expectation is in December of this year, but obviously the risks have been pulled forward that maybe a cut in September is possible. So, that eases some of the risk. The fact that we've seen credit spreads have been low. Some companies have been willing to refinance even though rates are high because, credit backdrop's been supportive. So, that's the risk, is if we see credit spreads, start to rise again, that could become a headwind to the profitability as well. So, I think this is a backdrop where you want to be selective within small caps and not just buy the Russell, which, we think further clarity on the profitability backdrop could help. But for now, our analysts at BofA cover about 1,000 small and mid-cap stocks. I think there's a lot of opportunities for alpha if you can focus on, like I said, the names that actually just have positive estimate revisions in a backdrop where revisions have still been coming down. Guidance has been weaker in small caps, some of the value stocks. But, we're watching what companies are saying this earnings season. If guidance can get a bit better, it's still been a bit weak, within small caps, then, companies beating and raising, I think, could be supportive of a broader, index rally and, similar to the risk rally we saw over the past week or two.
Jill, I have to ask about the third camp that Lisa alluded to, the politics. How much is small caps a bet on Trump-Vance?
Well, I think when you look at, the rally over the past week, really some of the initial drivers were more on positioning and, risk on. We saw financials as a big rally, deep value stocks. We saw stocks with high short interest rally as we saw some initial short covering. And when we've looked back, really, while certain political factors or political policies can certainly impact small caps when you're looking at tax rates or when you're looking at policies that could impact growth, overall, we found that profits tend to matter more than politics for small caps and for equities. So, I think what's going on with GDP and interest rates is going to be a bigger driver of the index than necessarily which political party's in office.
That's the piece of the story we're all waiting for. Jill, it's great to catch up. Jill Carey Hall there of Bank of America, sort of echoing what we heard from Brian Levitt. Brian was much more brutal about it. Much ado about nothing. That's what he said the politics was for this market.
Basically all noise, and anyone who really talks about a Trump trade, he finds a lot of logical fallacy, as he put it earlier this morning.
That's a kind way of putting it. Coming up on this programme, in the third hour of Bloomberg Surveillance, we'll catch up with Don Stoltzfus of Oppenheimer, Stefan Slowinski of BNP Paribas Exane, Marc Giannoni of Barclays, and Sophia Drossos of Point72. All of that still to come from New York. This is Bloomberg.
AI theme is still expected to do most of the heavy lifting for earnings growth.
We think the market has been a momentum, growth, and size market this year.
We're hoping that some of that performance can spread into the smaller cap area.
We all know breadth has been far too narrow, right? And that leadership needs to expand.
I really want to see which way the earnings go. The big tech names, continue their dominance. Maybe things get a little bit better. I can see investors going back there pretty easily.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance begins right now with a big focus on the earnings. A little bit later, we hear from Google and we hear from Tesla. Already this morning, hearing from a few names. I want to pick out these two names. I want to talk about GM, which is up nicely in the pre-market by close to 5%, and Coca-Cola up by 1.7%. Now, I know it's difficult to get a clean read on earnings at the best of times, and it's always easy to cherry pick a company or two and try and talk about a beautiful, clean story. But I'll tell this story. We started earnings season with Delta and Pepsi, and those two names didn't really spell out a good picture for the US consumer. This is better. Americans are buying trucks, things are better over at GM. Coca-Cola's telling you a story that Pepsi couldn't a few weeks back.
Basically beating and raising full-year outlook as they see their products still very much in demand. It raises a question about whether the weakness that we see in some companies is due to just execution risks or issues with their actual business model or just failed bets versus an actual truly weakening economy. What you can see in GM is sort of a fascinating microcosm of the shift that's going on in the car industry. Basically going back to gas trucks, selling them to Americans, and pulling back some of their investments in electric vehicle factories, really highlighting how much the tide has shifted in that industry.
This is going to become a bigger campaign issue. Not the campaign issue, obviously, but a bigger campaign issue with Elon Musk and Tesla at the epicenter of this conversation.
Absolutely, because you have Tesla, which arguably would benefit from some of Biden's policies and what the Trump campaign calls, which isn't, but calls an EV mandate. At the same time, Elon Musk is all in, as we've seen, on the money and the endorsement to Donald Trump. I find it fascinating for GM, and John, you know this very well because you spoke to Mary Barra about this. The transformation at GM, this arc of we're going so hard on EVs, well, actually, we think people might actually want hybrids, and now it's like, all right, we got to get our bottom line up. We're going to sell gas guzzlers.
Well, it goes to the point that we've talked about extensively on the show, which is essentially there is this long-term outlook that's the same for a lot of these auto manufacturers. They still are talking about a net zero type of pledge and moving to more electric or more environmentally friendly cars. It's the pace, it's exactly what's going to cause the bottom line to go up, and it's the incentives in terms of is it a government incentive or is it just what the demand is in the market? And right now the demand is U.S. trucks, and if you go on any highway, that's what you can see.
It's perfectly framed. The destination hasn't changed. This is just about the pace, the time it's going to take to get there. Let's talk about the broader price action for you. If you are just joining us, welcome. This is what it looks like. Really decent day of gains yesterday across the board. On the Nasdaq 100, we absolutely ripped after the 4% loss through last week. We're up this morning by just short of 0.1% on the S&P. In the bond market, yields are lower by 2 basis points, the 10-year 423.10. And in foreign exchange, the dollar just a little bit stronger here against the euro. No drama, 108.59. We're down about 1/3 on that currency pair. Coming up this hour, we'll catch up with John Stoltzfus of Oppenheimer as the Mag 7 bounces back. Stefan Slowinski of BNP Paribas Exane previewing Alphabet's earnings a little bit later, and Sophia Drossos of Point72 on what this week's data might mean for the Federal Reserve decision next week. We begin with the big issue, big tech back in the spotlight. Tech stocks driving the S&P to the best day since June. John Stoltzfus of Oppenheimer remaining bullish, and he has this to say. We see last week's market action as some prudent consideration by investors in addressing a need to redistribute the weighting of opportunity and risks. That said, and here's the bottom line for him, we remain positive on tech stocks, suggesting that investors don't change horses in the middle of a stream. John joins us now for more. John, good morning to you, sir.
Good morning.
Want to pick up on that last line. It's going to be a big week or so for tech earnings. Alphabet later, the bigger players next week. Are you saying stick with those winners?
I think you do stick with the winners. These are companies that have proven profitability and are deeply embedded with the lives of both business and the consumers. We're not going back to the abacus or abacus, however one wants to pronounce it, and we're not going back to the slide rule either. So I think in the process of that, we've got to see that chips indeed do rule. and where we are as the transition in terms of where they're going to be manufactured. Those are the issues.
At times over the last few weeks, we've had people come on the programme and say, trim some of those winners, rotate into things like small caps and banks. What have you made of that argument that's been made?
Oh, I think it's a good one. I think that the process of diversification is necessary. It just depends upon the needs and objectives and tolerance of risk of the institution or the individual investor as to how you manage it. But you need exposure in our belief to these magnificent seven, in the sense that they are just so important. We're all on an upgrade cycle. One of them decided that the next phone that they put out is going to have a chip that you'll have to have either this year's model or next year's model. Everything underneath it becomes an anachronism. It looks like a huge upgrade cycle for laptops, PCs, phones, and all things technical as we move forward with AI. Not the Star Wars stuff of AI, but the AI in terms of where we're headed, just making things more efficient.
Was that a raging endorsement of Apple there?
I do not speak about individual companies because I manage money for the firm. So it was just, if it sounds like it, what can I say, Lisa?
Just going a little bit deeper, you were talking about not changing horses in the middle of the stream. Another aphorism was maybe try to catch some of the babies that have been thrown out with the bathwater in the near-term volatility. So have some of the big tech darlings been thrown out with the bathwater? Are those the babies that you want to catch after a little bit of a downturn recently?
Last week, it certainly was the case, and the bears jumped on the thing that it was just overdone and this is the end of this, but I think in terms of small caps, I've built positions in small caps in a portfolio that I managed for years now under much criticism, but luckily we were well diversified and we also included exposure to technology in other areas. So we may have we performed well within our class of what in our peers. But this is a transitional time. I believe it's a watershed. It's a watershed that's very similar to, probably on parallel to where the automobile was in the early 20th century after Henry Ford had essentially upgraded the manufacture of automobiles by mechanizing the assembly line, bringing up quality and lowering cost. And once the genie comes out of the bottle, the technology genie, it never goes back.
You could talk about the same language, watershed moment, the genie out of the bottle, with the political cycle as well, and this real question around the turmoil in that space and what that means for markets. We were talking with earlier this morning with Brian Levitt of Oppenheimer, and he said it was basically a fallacy, this whole Trump trade, and it's been. Well, but this concept right now of this idea, how much do you look to bonds as being the real kind of volatility drivers in an election cycle?
Yeah, we think bonds are highly complementary in light of expectations that the Fed will be cutting rates. So it's a good time to pick up some things. You got to watch for your callability. Your treasuries are probably a better bet. But tax-free municipals and things like that help to diversify. But when it comes to fixed income, I'm just not a big fan of thinking that bonds are going to outperform stocks in this particular period.
Well, going back to what Brian said to us, though, he said the Trump trade was much to do about nothing. Do you start to put on some investment, or do you start to look at potentially have an election base case and start to put on some trades?
I think it's a little bit early for that. I think both sides are going to be doing the first shots across the bow in terms of what they talk about. And when they talk about tariffs, or if they're talking about tax cuts or raising taxes, all this stuff is the first part of the spin. That we have to see what actually happens.
But not all of it is spin, in the sense that Kamala Harris is likely going to be the nominee for Democrats now. Mm-hmm. She's part of a current administration, so an incumbent in a sense.
Sure.
And Donald Trump had 4 years in office, so he's also an incumbent. Yep. So couldn't you take their policies over those years and implement them into the market? You
could, but policy is often shaped by what occurs in the economy, by monetary policy. For years you'll see when we come out of a recession, whatever administration is in the White House will claim that they are what really is doing it. It's the Fed, folks. It really is. And the importance of the Fed being independent, we think, is extraordinarily important this year. If anything, we're concerned that we just hope they don't cut too soon, should they cut in September. which is all the highly leveraged crowd wants to see.
Okay, pause. Let's build on that. I think this is an interesting point. We had a guest only an hour ago who said they need to cut soon and quick and fast. And you're saying you're worried they might cut too soon.
Yeah.
September might be too soon.
I think September is too soon for one. If the Fed's detractors will say it's politically motivated and questions the independence of the Fed. The other side is inflation, as we've always said, is insidious. Having lived through it in the early 70s, I remember it very well. I mean, there's almost an element of PTSD when you see inflation come into the economic scene if you've lived through it.
You're saying it's sticky?
Yeah. I still think it remains sticky in certain areas. We haven't seen competition come back in force to battle that stickiness. And we think that the Fed would probably be best advised to, I don't doubt they'll listen to me, but I would go with November and December, 25 bips at a shot. It's a down payment for Main Street and Wall Street that says, we're going to be cutting, don't get too excited, we're going to be still data dependent. And I think Jerome Powell, does not want to spoil his legacy. He's done a pretty good job since March of 2022. He missed in the beginning, he fell by, he was behind the curve, but he got into it, and he's done a great job with 19 Fed meetings and no recession during a Fed funds hike cycle. That's extraordinary. Aided and abetted by the economy and trends that are demographic and other stuff, but the Fed's been right on.
Unemployment's still around 4%.
Yeah.
And I have to go back to Jackson Hole's. I think if we all sat around this table and said, can inflation get back down to somewhere close to 3 with unemployment still in at around 4? There would have been big doubts about that. You're still conditioned by your mortgage payment in the 80s, aren't you?
I am, but you've got to remember, property was so cheap back then, okay? But it looked expensive to us.
That's why I don't feel sorry for you. You had that $200,000 penthouse apartment looking over Central Park.
I love the stories. I'm built up. I mean, there's a difference between the myth and the legend and the person and all that stuff.
Well, so meanwhile, going forward, I am curious, what's your most contrarian bet right now, given that you've been positive for a while? Has there been anything that's shifted?
I think the contrarian bet really that we have is that if the Fed cuts in September, it wouldn't necessarily be a good thing. And if the Fed doesn't cut in September, you'll probably see the small caps pull back. They'll give back a lot of these gains, just as they did at the beginning of this year.
So just to be clear, primarily you think the small cap move has been a rate story?
Oh, yep. I believe it's a rate story, and small caps have been ignored because they're considered but longer duration.
To tie it together then, for an individual that thinks they shouldn't cut until November, how can you recommend small caps?
Oh, well, because you want to build your positions while they're relatively cheap to where they're likely to go. This is just, again, this thematic of today, the first shot across the bow.
Got it.
The interest that we're seeing in small caps.
John, appreciate your time. It's good to see you.
Great to see you all.
Thank you, sir. John Stoltzfus there of Oppenheimer, not PIMCO or Invesco.
Okay. Brian, I'm sorry. Brian Levitt of Invesco, not of PIMCO, not of Oppenheimer. We're trying here.
Let's get you an update on stories elsewhere this morning. It's not personal. It's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Philip Morris is higher in the pre-market, more than 2%. It reported earnings in the last hour. It lifted annual profit growth forecast thanks to blockbuster demand for its Zyn nicotine pouches, even though it has some supply shortage issues. Philip Morris has been focusing on efforts on cigarette alternatives. It said earlier this month it would spend $600 million in a new facility to make Zyn in the U.S. Annual sales of the nicotine pouches will hit as much as 580 million cans, the company said, up from its previous 560 million forecast. Delta Airways says that it expects to cancel more flights this week as it tries to recover from Friday's global tech outage. Delta grounded nearly 900 flights on Monday. That brings its total since Friday's meltdown to more than 4,700. The company said it is working around the clock to restore operations. In a post on X, U.S. Transportation Secretary Pete Buttigieg criticized Delta over the disruptions, saying the department had received reports of unacceptable customer service conditions. China's richest man is at risk of losing that distinction as losses continue to pile up. Zhang Shanshang, who runs a bottled water giant in the country, has seen his net worth fall by $13 billion so far this year. That's among the most for billionaires worldwide. The losses are tied to a price war among bottled water brands, with the Hong Kong-listed company on the wrong side of increasingly nationalistic and health-conscious Chinese consumers in recent months. And that's your Bloomberg Brief. John.
Danny, thank you. That last line, so important for anyone selling into China right now. The increasing nationalism that we're starting to see. I'm thinking about Apple again next week. If that's something that just sticks around for a longer period of time, because the surprise last time around, remember, China was better than expected coming out of Apple. I just wonder if that sticks.
If anyone listened to Xi Jinping's rhetoric in the recent meeting, in the recent confab, it was talking about increasing production, increasing just self-reliance, and fortifying their supply chains. There was not any discussion, much discussion, barely, about housing and some of the property prices, or potentially even consumer spending.
We talk a lot about the prospect of protectionism, increased trade barriers on this side of the story, and maybe not enough on what's happening on the other side. Up next on the programme, we'll get you some morning calls, and then we'll catch up with Stefan Slowinski of BNP Paribas Exane, looking ahead to Alphabet earnings out after the closing bell. All of that and more still to come from New York. You're watching Bloomberg Surveillance. Equities changed on the S&P 500, going nowhere, into the opening bell about 1 hour and 12 minutes away. Let's get you some morning calls. First up, Baird lowering its price target on CrowdStrike to 335, keeping an outperform rating on the stock, but the firm saying that financial and legal ramifications remain top of mind after Friday's global tech outage, and apparently some airlines, Delta, still struggling with that. That stock is up by 1.3% in the pre-market. Next up, Morgan Stanley upgrading Snap to equal weight with a $16 price target. The analyst highlighting improving ad performance and a more reasonable valuation compared to its peers. That stock is higher in the pre-market by 3%. And finally, Piper Sandler raising its price target on Microsoft to $485, maintaining an overweight rating. The firm highlighting that it could take just 3 years to add $100 billion in cloud revenue, thanks to AI. That's compared to the 13 years it took to cross the milestone the first time. That stock is up in a pre-market in early trading by about 0.25%. Looking ahead to the big tech earnings through the next week or so, BNP Paribas Exane raising its price target on Alphabet to 210. Analyst Stefan Slowinski saying inline might be the new beat and raise this quarter. Investors waiting to see whether the generative AI hype will continue. Stefan joins us now for more. Now, Stefan, typically when we talk about inline being the new beat, usually that's relative to pretty downbeat expectations. Now, Stefan, I'm looking at the stock this year. Google's up by 30% year to date. How can inline be the new beat?
Yeah, hi, Jonathan. Thanks for having me on. And obviously, in the last few weeks or a couple of months, we've seen some sluggishness in IT demand overall. I think more on the software side. We recently published our channel checks on enterprise software, which did show significant weakening over the last 3 months. And so we're seeing in some areas of tech, like we're seeing today on SAP, for example, where last night they came in line on revenues, in line on bookings. Stock is up 5 or 6% because of concerns. I do think it is a little bit different in the digital advertising space. I think for Meta and Google, expectations have been creeping up. So maybe for them, they do need to beat in order to continue the momentum here.
Stefan, just on ad spend, just breathe some life into that conversation. Help us understand your perspective. Are we saying there's a pullback in ad spend? Is it certain industries, certain markets? Where are you seeing that?
No, I definitely think that within ad spend, it's been holding up better than IT spend. So we have seen more weakening on the software side, the services side, with digital advertising holding up better. That said, we do have a digital ad tracker that we use for our forecast for Google and Meta. And they're both coming in pretty much in line with consensus, actually maybe even a smidge below when you include FX. So we're kind of in line. Last quarter, we weren't. Last quarter, we raised our numbers going into results for Google. We were 3% ahead, and they did beat by 3%. This quarter, we're just in line. But we do see other benefits. We think on Google Cloud, we could see them beat as they benefit from using Gemini to drive customers to Google Cloud Platform, benefit from Gemini for Workspace and their SaaS business. And we also think on the margin, they're continuing to stick with that sort of extended year of efficiency we should see GAAP margins once again above 30%. So we see a bit of a mixed quarter for Alphabet coming up here tonight.
Stefan, I want to just sort of dig into the mix of that, this idea that the inline may be the new beat and raise, as long as there is a beat under the hood when it comes to cloud, as long as their capital expenditure budget continues to increase and beat expectations so that they can invest in the future. Is that kind of the asterisk next to this sort of inline as the new beat and raise?
I think the broader debate here that we've been having with institutional investors over the last few weeks has been sort of the hardware versus software trade, but also hardware versus software versus large cap internet. You know, the SOX is up 33%, large cap internet is up around 31%, software is only up around 9%. So one of the things that we're just cautioning about is that second derivative. Beware of the second derivative. We will see growth slowing here in digital advertising year over year. We will see growth slowing probably for some of the big hardware names. I think on the software side, it's underperformed this year to date. And actually, we have companies where software revenue growth is actually accelerating. So I think on the software side, we're seeing maybe a bit more opportunity in the second half of the year than maybe large cap internet and hardware for the time being.
There's also kind of an elephant in the room, Stefan, especially after the whole CrowdStrike issue that really highlighted how many companies use CrowdStrike on their Microsoft software in order to ensure against cybersecurity attacks. It raises this question about sort of the liability of being too dependent on one particular provider. Do you expect that to come through either in the earnings or in regulatory risk that a lot of these companies are facing anew?
I don't think so. I think it's not necessarily something new. And I think, you know, obviously a lot of enterprises, when they're buying IT, try to diversify to a certain extent. So maybe we'll see that creep up more in the risk sections of 10Ks. But I don't think it really changes buying patterns. I think the other thing to mention here is when you do look at the various different components going into the second half of the year and the political risk around some of these companies with elections and tariffs and rhetoric. Again, on the software side of things, you don't have that. Most of the large cap software companies, even Microsoft, have very limited exposure to China. You do see that more, of course, on hardware and even potentially the large cap internet names being impacted from advertising trends where the Chinese are large advertisers on some of the big internet platforms.
Stefan, if you're worried about political risk, is that why you haven't underperformed for Meta?
And it's a part of it. You know, I think the market was looking at political risk on Meta as a potential tailwind with the banning of TikTok. We didn't really think that would kind of play out just because there's a lot of vested interest in making sure that TikTok stays up and running in the U.S. And certainly looks like, based on President Trump's recent comments, that he would allow TikTok to stay up and running. And actually, so that could turn into a headwind for Meta. So that is a challenge. Again, with the elections as well, it's uncertain if advertisers will want to be associated with user-generated content during an election cycle. Maybe they will, maybe they won't, but that's another risk. But our caution there is a bit more on their AI spending and reallocating spending from core AI, which is driving growth, and that's their recommendation engine and ad targeting technologies, to Gen AI, which is the large language models, Llama, and the Meta AI services, which aren't driving revenues yet. Now, if we do see Meta next week say that they're going to be cutting Reality Labs spend to invest in AI, that would be a positive catalyst. But for now, they're saying that Reality Labs losses will continue to accelerate.
Hey, Stefan, great to get your thoughts going into these Alphabet numbers a little bit later with some real thoughts about the likes of Meta as well at the end there. Stefan Stoltzfus there of BNP Paribas Exane. Fantastic exchange with Emily Chang and Mark Zuckerberg. And I have to say that one clip, I saw that absolutely everywhere over the weekend, as Mark Zuckerberg comes out and says that he thought the former president's reaction to that assassination attempt was one of the most badass things he'd ever seen. And I think we all thought, listening to that, being aware of the conversation we just had, that sounded like a guy that was maybe trying to cozy up to the former president just a little bit.
100%, because he also went into saying he's not going to really endorse one candidate or another. This is someone who's trying to play his cards right so he avoids some of the crosshairs of politics.
Coming up next on this program, we'll catch up with Sophia Drossos of Point 72 alongside Marc Giannoni of Barclays. From New York City, this is Bloomberg. So just before the commercial break, we mentioned that sit-down, that conversation with Mark Zuckerberg of Meta and Bloomberg's Emily Chang. That interview, I know many of you have seen the clips, that one clip, that interview in its entirety a little bit later on Bloomberg TV at 6:30 Eastern Time. Don't miss it. Equity futures on the S&P about an hour away from the opening bell look a little something like this. We're down about 0.1%. Yesterday, fantastic day of gains across the board here. Best day since early June on the S&P 500. Nasdaq had a stellar day as well, driven by Mag 7 stocks. The big names, the likes of Nvidia bouncing back. Going into earnings over the next couple of weeks for big tech. You've got to wait until the end of August to hear from Nvidia. Nvidia's a big deal now. Can they sort that out? Can we bring that in?
bring that earlier because we just have to wait for them?
I think we have to bring that in.
Okay, we'll submit a call.
Whoever sits down with Jensen next, bring that in. That's one request for earnings. The other request, bank earnings. Just do them after the bell.
Oh, no.
You know how I feel about bank earnings.
Yeah, I know. You want to be able to digest
Everyone's
them.
busy
and
in the morning. They haven't got time to listen to their calls.
But that
and go through the numbers.
They do. We then have to break them in a sort of haphazard way.
It's a bit of a rush. You sort of screen through a bunch of numbers.
Exactly.
And, maybe they like it that way. I don't know. All right. That's the equity story, not much of one I know. In bonds, we look like this, 2-year, 10-year, 30-year. The 2-year shaping up as follows. Yields down by about a basis point, 450.83. We're down a single basis point on the 10-year, about 423.69. I want to turn to foreign exchange and finish on the Japanese yen. We'll talk more about this in just a moment. Dollar yen 156.23, negative 0.5%. That's a stronger Japanese yen every day this week, Monday, Tuesday. Going into next week, real conversation about whether or not we get this hike from the BOJ.
Which raises the question, is the strength we're seeing in the yen because of a Bank of Japan likely policy shift, especially considering the fact that they came out and kind of put a little cold water over the idea of it, talking about some of the weakening in consumer spending in Japan, or raising questions around their confidence to really tighten policy? Or is this a U.S. story entirely? Is this basically the idea that a red sweep and some of the more protectionist policies would strengthen the dollar? That trade, at least people are closing out a little bit, and that's giving some steam to the yen.
Well, at least we know that if we get Trump Volume 2, he will have a close partner in Japan because they'll agree on the same thing. The president wants a weaker currency and they want a stronger one. Doesn't that all add up? Doesn't that work?
Keep
Dollar
going with
back
that.
to 100?
I mean, all I can say, did you read all of the scathing notes about how is he going to get that? That's absolutely ridiculous.
I guess he needs a Treasury Secretary that's just going to, buy a lot of yen?
I'm not sure how you engineer that. Especially if you're going to have big tariffs and cut immigration aggressively, you'd think that would outweigh everything else.
This is the reason why I think people are having a difficult time understanding what the Trump trade actually looks like, because there's a lot of speaking out of all sides of the mouth and a lot of train of thought. It's unclear whether that's actually policy. And you don't know who's going to be in the office. And then when you actually look at the policies and you put that against market reaction, and then his goals.
The backdrop is so different too. In 2016, we were pleading for fiscal stimulus.
Right.
We had low growth, we had low rates. I think we sat on this program all the time saying, you should probably do something. Even the chair of the Federal Reserve was testifying and saying, you guys should probably do something. Backdrop now, totally different.
Which is a reason why bond auctions matter. We're going to get $69 billion of 2-year notes today. We're going to get $70 billion of 5-year notes tomorrow and $44 billion of 7-year notes on Thursday. This, to me, is the real presidential trade, because either way, you are going to get a fiscal deficit that is larger. And now you got to wonder, okay, how do you offset that on the margins? And that's where I think there could be the most volatility.
Sure, okay, that's your conclusion to everything. All right, top stories. Under surveillance this morning, I agree it matters, just every story. Okay, shares of GM, General Electric, Coca-Cola rising in the pre-market. The companies all reporting quarterly results that beat Wall Street estimates. On the flip side, UPS missing profit estimates amid rising pressure from wages and soft package demand as well. UPS is down about 8%. Lisa, do you think we can park that story this morning, say it's idiosyncratic and focus on the rest, or is that too easy, too simple?
I would suggest it's too easy and too simple, especially in light of what we heard from the airlines. It's not just higher expenses. It's also lower package revenue. I'd be curious to see what we see from FedEx, other places. You can't ignore certain signs of weakness. It's just hard to know how to put it together with the signs of strength that we're seeing from the likes of GM, from the likes of Coca-Cola, from the likes of the banks that are posting record profits. It is very difficult to understand whether we're seeing weakness, as evidenced by the lack of earnings growth that we're seeing in the Russell 2000, or true strength, the fact that people are still buying big trucks and going crazy with them.
Over at GM, earnings season picking up big time later. We'll hear from the likes of Tesla and we'll hear from the likes of Alphabet. And then tomorrow morning, Lisa's going to draw that all back to the deficit in America and the bond supply you get later this week. I know you will.
I know.
Kamala Harris starting to pick up key Democratic endorsements. That list now including former House Speaker Nancy Pelosi. CNN reporting that Senate Majority Leader Chuck Schumer and House Minority Leader Hakeem Jeffries are expected to endorse Harris soon. Scene, OK? New York City, breakfast, OK? I'm eating, I'm chill. Bit of scrambled eggs, decaf cappuccino. Just relax, just a little bit. Can't handle the caffeine. Don't need to come back up after the show. All right. Poor Chuck Schumer. Walking through the restaurant. What does this one do? Anne-Marie, like a shot. Just leaves breakfast like a shot. You're going to endorse Harris. You're going to endorse Harris. What did he say to you yesterday?
He said, I'm not making any comments. And then I said, OK, well, when are you going to potentially make a comment? He said, I have a statement later today. So I said, are you going to endorse her in your statement later today? He goes, do not put words in my mouth. I'm making no statements. And then he rushed into a car.
If you are an official and you go into a restaurant and you see this one, just turn around and go back to the exit.
We need to know answers.
Okay.
Everyone was coming out. Where was he? He was the one that was supposed to have this come to Jesus moment with Biden in Delaware. So where was his endorsement?
True. I think we're still waiting, right?
Still waiting. Potentially it's going to come today.
OK, look out for that. Let's turn to this. Investors keeping an eye on US data this week, including GDP and PCE. Both prints will paint a better picture of what the Fed's next move will be. Fed officials are expected to hold rates steady once more at next week's meeting. Markets still broadly pricing in 2 cuts this year. Joining us around the table, I'm pleased to say, still with us, is Sophia Drossos of Point72 and Marc Giannoni of Barclays. Sophia, I want to come to you first. The likes of Goldman have come out and said, why wait, let's go. They've sort of put forward this argument that maybe the Federal Reserve should consider cutting interest rates this month. Do you share that particular view? Because we had another guest on in the last hour who said that they should wait, and maybe they should wait until after the election.
Well, good morning. And that's definitely a debate in the market. But what I would say is that this is a very unusual cycle. The Fed's not facing the urgency of needing to cut because the economy is falling apart. Usually when the Fed is turning around and pivoting to rate cuts, we see more material weakness in the economy. This time around, it's not what we're seeing. This time around, we are seeing the economy hold up well as price pressures recede, and the Fed's making a judgment that it can cut back on the amount of policy restraint it has delivered to the economy. So there's not the same urgency. And while you can sort of discuss the fact that inflation has probably come down a little bit faster in the last couple of months than was expected, the Fed doesn't need to be in a rush. And it's a very consensus-based institution, as you know. So perhaps it's this meeting where the Fed gets its ducks in a row and unveils its strategy for reducing the amount of monetary restraint.
And that's why there's broad consensus that September may well be the month they actually make a move. Marc, I'll throw the same question at you. Goldman say, why wait? It's interesting that you indicate that you think, sort of, why not wait? Why not wait?
Yeah, good morning. Yeah, I think, the question for us is what's the rush? The inflation has improved a lot. So, yes, it has come down. And in particular in June, we had like a lot of improvement. But we've seen, in the first 3 months of this year that inflation bounced back again, like for a few months before coming back down. So I think the situation that we are in is one where inflation is gradually trending down, but we'll have likely a few bumps along the road. And on the labor market is still pretty solid, pretty resilient. We still create about 200,000 jobs. The unemployment rate edged up a little bit, but we think this is largely due to the boost to supply of labor coming from immigration. So we don't see any signs of a rapid deterioration. And you noted before that consumption, we'll have some information about that later this week, but we think that so far the signs are, based on retail sales data, for instance, that consumption is still very resilient to this point.
Marc, you raise a point that actually flies the face of what Ian Shepherdson was making earlier this morning, where he was saying he thinks the Fed could cut by 150 basis points in the next 18 months or so, possibly more, just simply because inflation is falling so quickly and will continue to do so. You seem to think that actually the Fed isn't that restrictive, and we're seeing an economy that's handling just fine, the rates where they are. Can you explain sort of why you see inflation as stickier and rates being closer to neutral than not here?
Yeah, so I think, this economy still generates a fair amount of income. Every month we keep hiring about 200,000 jobs. With these jobs create a lot of income. That income keeps fueling consumption. So the consumer turns around, buys all sorts of goods and services, and that keeps pressure up on prices. So yes, we are seeing the trend down. Inflation is no longer as high as it was in 22, 23. It's improving. But hey, on a year-over-year basis, we still have around 3% inflation, depending on what indicator you look like. And on a year-over-year basis, conditions are going to deteriorate going forward. So the improvement that we are seeing is really on a month-to-month basis that we see these inflation prints gradually coming down. And we could have a lot of surprises on the upside as well.
Sophia, do you agree with that? That right now people are not really understanding to the full degree how much inflation is sticky and could inflect higher in the months to come in a way that maybe people are saying is sort of out of the picture right now as they project Fed rate cuts?
Well, I think the beginning of the year, the disruption we saw to the disinflation process was really driven by some idiosyncratic factors, whether it was some one-offs here and there in specific categories or mismeasurement in rents and the like, and certainly some of the typical beginning of the year seasonal pressures that you see in prices. So from my standpoint, I think inflation really does now, if I look at the month-on-month run rate, I'm relaxed about where it's headed. Obviously, we want to see it continue to move in that direction. But really, the Fed, I think, has changed the balance with regard to how they're looking at things. They're talking a lot more about not wanting to overstay their welcome, not keep policy overly tight, or tighter than it needs to be. And I think that the market is catching onto that. And of course, we've seen the big shift in market pricing of Fed expectations in the last few weeks.
Marc, you talked about Trump momentum riding high. Do you still see that potentially, given the fact that we have basically a restart of the election?
So, yeah, well, I think there is, if we look just at the market probabilities, it looks like the Trump administration has an advantage to this point, but we can see a lot of changes in the next 100 days or so. So I think there is, it's going to be a pretty close race in any case. At this point, I think the Trump administration would generate some upside risk to inflation as well going forward. But this is more 2025, 2026 problem than it is a 2024 problem. I don't think that that's going to affect the Fed's decision this year, but this is something that could impose some upside risk to inflation next year.
Hey, Marc, thank you. Alongside Sophia, to the both of you, thank you very much. Just want to bring you some news just quickly. Those of you struggling with Delta Airlines over the last few days, this from Secretary Pete Buttigieg, the Department of Transportation opening an investigation into Delta Airlines to ensure the airline is following the law and taking care of its passengers during continued widespread disruptions. All airline passengers have the right to be treated fairly. He goes on to say, and I will make sure that right is upheld. Let's get you some stories elsewhere with your Bloomberg brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. Big tech earnings are going to be kicking off in the afternoon. Both Tesla and Alphabet will be reporting. For Alphabet, analysts are likely to be focusing on the Google parent company's AI-based revenue. It is looking to compete with the likes of OpenAI and Microsoft. Now, for Tesla, investors want answers about its delayed robo-taxi rollout, as well as CEO Elon Musk's move to elevate AI over EVs. Now, elsewhere, VP Kamala Harris is hitting the campaign trail with a rally in Milwaukee later today, where Republicans just held their convention last week. Harris has secured the endorsement of nearly every major Democrat and announced a record-breaking fundraising haul of more than $100 million during her first day as a presidential candidate. Taiwan has suspended trading on its $2.4 trillion stock market as Typhoon Garmi approaches landfall. A government statement also said that Taiwan would shut schools and offices in Taipei. The intensity and size has increased, and the trend is expected to continue with wind gusts of up to 118 miles per hour. The typhoon is expected to make landfall sometime Wednesday night in the early hours of Thursday. And that's your brief, John.
Danny, thank you. Up next on the program, Larry Culp, the GE chairman and CEO, sitting alongside our good friend Bloomberg's Guy Johnson. Must watch TV up next on the program. This is Bloomberg. Equity slightly softer here. We're down by about 0.1% on the S&P. The opening bell in about 44 minutes' time. Let's cross over to Guy Johnson in Windsor, England. Sounds very official and royal, doesn't it? Sitting down with the GE CEO, Larry Culp. Guy, over to you.
Yeah, we've got some aerospace royalty here in the room. As you say, Larry Culp, the CEO and chair of General Electric, the world's biggest jet engine manufacturer. John, this is a company that is newly independent. It's a standalone business. The first time we've seen numbers being reported on that basis, and the numbers we've seen being reported look good and being taken well by the market. The stock, I think, is up circa 3% this morning. It looks like a beat and a raise from Larry Culp. Good morning. Good afternoon, as I probably should say. Nice to have you with us. Thanks for joining us.
Guy, good to be with you.
Talk me through the strength. Talk me through where it has come from. Where is the strength of this beat and raise within the business?
Well, Guy, it's really rooted in the demand that we see both from the airlines and from the airframers for more of what we do. 70% of GE Aerospace on a standalone basis comes in the aftermarket, supporting the airlines with parts, with services of all types to keep today's fleets in the air. And given the activity that they're seeing with the flying public, it's all we can do to keep up with what they'd like to see from us. So the 60+% improvement in earnings, the nearly 20% improvement in free cash that we announced today is really a function of the strength that we're seeing in our commercial engines and services business in the aftermarket.
Is that sustainable? Does that carry on throughout the rest of this year into 2025? Is that something that is here now, gone tomorrow? Because we're starting to see some warnings coming through, particularly from the narrow-body operators in the United States and as of the beginning of this week with Ryanair here in Europe.
Well, we've certainly seen those as well. Seems like that commentary is really geared more toward pricing than anything else. But if you look at our order book in the second quarter alone, nearly 40% year over year. We see our utilization of the fleets, both the mature fleet, which we power with the CFM56.
Yep.
That has been steady, an engine that folks thought might begin to fade. Our newer generation technology, the LEAP engine on both the 737 MAX and the Neo at Airbus, that's probably up 4 points in terms of share. So our utilization could not be higher. Even just looking at the third quarter here, we have probably 90% of our third quarter projection in backlog today with respect to parts. So in terms of the demand signals we're seeing from our customers, things are strong.
So the hours being flown are going to remain consistent, you think?
We believe so. Okay. And going forward, they're going to increase.
That's the kind of the older story. That's the existing fleet that's already out there. As you say, the maintenance story is very strong. The margin off that is very, very strong. The story certainly at the Farnborough Air Show and all the air shows recently and throughout this industry has been what has been happening with the supply chain. Airbus lowering its guidance for the year, talking about engines within that guidance. Is the supply chain story getting better or is it getting worse?
Guy, I'm strongly of the view it's getting better. It's really all about the rate of improvement.
Right.
And what we shared earlier today with investors is that we didn't have the output that we had anticipated in the second quarter with our newest generation engine in particular, with our LEAP engine. But we're going in using our flight deck, our lean operating model to help our suppliers help us. Jointly problem solving, really understanding constraints at the point of impact. And we saw tremendous results from that in the second quarter. Didn't translate into as many deliveries, perhaps as our airframer customers would have liked, but we saw 2/3 of the suppliers that we worked with improve their output to us by nearly twofold. So that's encouraging.
Just kind of talk me through what's happening. So originally the guidance was for a 25% improvement for that engine. Then you went, I think it was in April, you were kind of 10-15. Now you're at kind of flat to 5.
Exactly.
That feels like it's not getting better. You're telling me that it is, though below the surface, getting better.
It's not getting better at the rate that we had anticipated.
Yeah.
But it's getting better if you look at the sequential trends. And that, from an operating perspective, that's all that really matters. Week in, week out, quarter in, quarter out, are we seeing more and are we seeing more predictably?
Okay.
We're getting better in that regard. I'm encouraged by what I've seen here just in the first 3 weeks of July. A lot of work, not only in the second half still in front of us, but as we think about 25 and 26, but working in that way, yielding those sorts of results will, I think, put us all on the ramp.
So the benefit comes next year. That's when we start to see the big benefit coming through.
I think some of the actions that we took in the second quarter will help us in the third quarter and in the fourth quarter of this year.
Why is it taking, this was a question I put to Guillaume Faury a little bit earlier on, why is it taking so long to resolve this issue within the supply chain?
Well, I saw Guillaume yesterday. We talk about this every time we're together. I think it's important for everyone to remember, Guy, that we turned the industry down to almost zero during the pandemic. And what we're trying to do now is turn it all the way back on. And that's hard. We lost not only people during the pandemic, we lost a tremendous amount of experience, technical people throughout the supply chain, in Guillaume's facilities at Boeing, at GE Aerospace, and throughout the supply chain. We're building all of that capability back. And because those roles are filled now not by a 58-year-old, but perhaps by a 28-year-old, there's a lot we have to do in terms of not only adding capacity, but capability to meet the ramp that we all are embarked upon.
He told me this morning he thinks we've probably got another couple of years of it to go, though, until we resolve some of these issues. Does that timeline feel kind of about right to you as well?
We're trying to make progress every week, but I think this is a multi-year effort that the industry faces.
In terms of your, we bring up Guillaume Faury, how is your relationship changing with Airbus? You traditionally been really tight with Boeing. Tom Enders, who I know well, you know well now, is now on your board. Does that signal a change in relationship with Airbus?
Well, I think we have served both of the major airframers well over time, right? We don't have over 2/3 of the departures in the narrow-body space serving Boeing alone. We're very excited about the news we put out last week with the A321 XLR now approved, but only approved with the GE LEAP 1A, right, our engine. So there's a lot that we're doing with Airbus, not only in terms of the ramp, but next generation technology as well. And we're trying to be as strong and as good a partner to Guillaume and Christian and their teams as we possibly can be. We want to do the same thing with the folks at Boeing, of course. We can do that as long as we invest in technology, use flight deck to deliver safety, quality, delivery, and cost to their requirements, and jointly serve the airlines.
Defense, just spend a moment, if we can, as we conclude things, talking about defense. Do you think defense spending is going up? Do you think a Trump presidency would mean greater defense spending? Do you see defense spending going up in Europe in a Trump presidency because of the requirements in terms of debt to GDP, not debt to GDP, spending to GDP? How do you see that story progressing, and what does it mean ultimately for GE?
Well, I think on both sides of the Atlantic, given the authorities that I speak with, spending will be paced by the threat, and the threat is only increasing. Therefore, be it in combat aircraft, be it in rotary craft, the two areas that we serve most directly, we think we will see, looking out over the next 5 to 10 years, sustained growth.
Just one final quick question before I'm forced to throw back to the studio. Was it an easy decision to continue your contract? Can I 100% rule you out of the Boeing job?
How about 101%?
101%. There you go. 101%. I know the guys in the studio were talking about this a little bit earlier on. So 101%. There you go. John, Lisa, 101%. Larry Culp is staying at GE, and a fantastic set of numbers delivered earlier on today. Looks like the market likes what it hears. Back to you.
Hey, Guy, thanks, buddy. Thanks for that. Really enjoyed that conversation. Larry Culp, the GE chairman and CEO, sitting alongside our good friend, Guy Johnson. That's the end of that then, right?
It's not. He didn't say it was 102%. It could have been 105% sure. So we're not sure whether or not he can actually join.
Just a few days ago, the president of the United States was 100% running for re-election, and then all of a sudden things change in a dime.
Things change, but I think we know his position as things stand currently. Need a Nancy Pelosi, like the equivalent over at Boeing, say, we're waiting for his decision.
Exactly.
Right. Yeah.
All right. We'll wait until he gives us his decision, but he has to make a decision because the clock is ticking. I'm not going to do it. Well, it's
waiting for his decision.
Come on, keep
it's
working.
The team over at Boeing. Let's get to the trading diary. The week ahead looks a little something like this. President Biden returning to the White House today after ending his re-election campaign. Later on, we'll hear from Alphabet and Tesla reporting earnings after the closing bell. Tomorrow, Israeli Prime Minister Benjamin Netanyahu giving an address to Congress. And we get more earnings from Ford and IBM. Plus, we'll get some US PMIs, Thursday, GDP, and another round of jobless claims. And we'll round out the week Friday with UMich, consumer sentiment, and PCE. Tomorrow morning, we'll hear from Greg Battle of BNP Paribas, Ben Callow of Baird, Kate Moore of BlackRock, Sebastian Page of T. Rowe Price from New York City. For this morning, that does it for us. Thank you for tuning in to Bloomberg TV. This was Bloomberg Surveillance.